Assalamu alaikum friends, welcome to lecture 75 of strategic business reporting, and this topic is the last topic of your SBR because after this I will be moving on to the questions from the textbook, which is current issues. This is one of the core topic of SBR. If you're not good in current issue, you cannot pass the SBR exam. I'm repeating, if you are not thorough with your current issues, you are unlikely to pass the SBR exam because one whole question is on current issue. I think it's mostly question number 4 is about current issue. Okay, and this current issue is, as you can see on your screen, the data I've given is from September 2021 to June 2022. Make sure that you have the latest textbook SBR and the kit, which is from September to June 2022. And if you don't have the textbook, you can email me at sabiakhtar0@gmail.com and I will send you the soft copy over there, the Kaplan soft copy. I don't have the BPP with me. Both the revision kit and the textbook will be provided to you. Okay, so that's it. And now let's start with the current issue. This topic is equally important the way how your other standards are important, like your IFRS or IAS, right? And this current issue, this lecture is going to be one of the biggest lecture you can say, because I have included everything here. I'm not going to keep small separate videos for different current issue. The reason is because it becomes when you search, most of the students get confused. Okay, I want to show that this is very important. Everything in this video from the start to the end is so important. And also you need to go a little bit slow because this is not covered in your financial reporting. It's not covered earlier, so everything you are going to cover here is something new. So I have included everything here, whether it is your exposure draft, whether it is your management commentary, current issue, everything is in this video. You will get whatever is remaining part of your textbook. This is, if you go by your textbook, it is chapter 23, if I'm not mistaken, from your Kaplan textbook. This is chapter 23, current issue. Chapter 24 I'm not going to cover because it is the UK syllabus and I am doing the international syllabus for SBR. Okay, if anyone is doing the UK syllabus, you can read it on your own, the chapter 24. Okay, but I'm not doing it, so this will be your chapter 23, current issue. Okay, so let's start with the current issue. Okay, current issue is basically, it has not been built into an IFRS standard. It is going to be maybe in the future, right? It will be made into a standard, IFRS or IAS standard, but currently it is an issue that is going on. Okay, so you need to, and this current issue have impact on the financial statements. That's the reason why we need to understand the current issues also for your SBR exam. Okay, so let's start with the current issue. Okay, so you have to bear with me because this video is going to be it's plenty big enough. Okay, the length is long enough, so but you have to cover small pieces, and don't worry, at the end I will summarize everything whatever I have discussed. Okay, so you can note down these points. I have included everything from your textbook. I didn't cut out any word. The reason is because some of you are taking notes while seeing the video, so it's very important that you take the right notes with proper explanation and examples also. So let's start with the current issue. Okay, so this is what we are going to cover in this video. Your syllabus is going to cover current issue. Two things under current issues: the SBR syllabus. Okay, what does the SBR syllabus contains for the current issue, and the other one are deficiencies in the standard. This standards you have already studied previously, all the IFRS standards or IAS standards. Some of it there are deficiencies, so those deficiencies also come under current issue. That also can be asked from you in the current issue. Okay, so for example, if let's say some standard, okay, we have a list. Okay, I have a list for that later on. In after a few moments we'll come across that deficiencies. Okay, but for now there are some not all these standards, some standards have deficiencies, so it's listed there. Make sure that you go through these deficiencies. Okay, I have already covered it when I was explaining you the IFRS, the specific IFRS or IAS standard. Okay, maybe if you've forgotten, you might have to go back and revisit those videos. Okay, so let's start with the SBR syllabus. These are the key current issue. 4 areas we are going to cover. Okay, so this video is made up of 4 separate areas. First one is accounting in the current business environment. First one is talking about current issues. There are 3 current issues this year. Okay, this CM is from September 2021 till June 2022. 3 current issues which we are going to touch upon, and second is materiality. Okay, materiality also we have some practice statement based on materiality. Third is management commentary, and fourth is presentation and disclosure. Sometimes under materiality or management commentary or current issue also you might be having this part presentation and disclosure. Don't get confused. That presentation and disclosure and this presentation and disclosure are different. Okay, this presentation and disclosure is for the wide area. It includes all the areas where you need to present and disclose. Okay, so this video now just visualize or make a map that this video is going to cover 4 parts, separate part. Okay, so first part we are going to cover is the first one, accounting in current business environment. But before that, let us go to the deficiencies in the standard. All the standard I have listed out for you here is from your textbook only. Okay, and this is from your Kaplan textbook, by the way. Okay, because if you are using BPP textbook, your chapter number might be different. Okay, I don't know the chapter number, I don't have the textbook with me, but make sure that you go and check it accordingly. At least you know the standard, so you know. Okay, okay, most important is not the chapter but the standard. This is existing standard, they are already existing. Okay, not new standard. So first is IS1. Some criticism is there, I have covered it in IS1. IFRS 15 revenue, IFRS 2 share based payment, IS 37 provision, IFRS 8 operating segment, IFRS 3 business combination, and IS 7 statement of cash flow. Statement of cash flow we are going to cover a little bit more in detail in this video itself under the last one, presentation and disclosure. Okay, other standards we are not going to focus so much of attention, but IS 7, yes. Okay, so as I have mentioned in the first one, it's in the bracket, it's from Kaplan, means the others are also from Kaplan. As you can see, IS1 is you will get it in chapter 3. Okay, different textbook, so make sure that you have the latest textbook. Okay, so now let us move on to the first part, that is the SBR syllabus, the key current issues. Deficiencies part is over now. Make sure that you write down all this standard somewhere so that you know that later when you have to revisit you can go and revisit. But if you have already covered the criticism, then it's okay, this is, you can skip. First one is accounting in the current business environment. Okay, so there are 3 current issue. First, cryptocurrency. Okay, first current issue is cryptocurrency. There is issue with it. What is the meaning of current issue? Current issue means it is currently it is an issue now. Later they will try some way, they will come up with some standard to solve it. But currently it is an issue. Okay, it is very new, latest. You should be very aware of this things that's going on currently in the environment. So one is cryptocurrency, which is a new something, and you should know how to account for it because there are some issues. Issues means always problems. Okay, then we have initial coin offerings, the second current issue, initial coin offerings, and the third one is natural disaster. So you should know this 3 current issue: cryptocurrency, initial coin offerings, natural disaster. This 3, the way it impacts your financial statements are different, the way you account for it are different, you should know. Okay, they are not the same. So first, under natural disaster, little more I have break it down for you. Okay, this is like a summary, it's like a heading. Before I actually go deep into these topics, this is just a summary of what I'm going to cover. Impairment, because whenever natural disaster happens, assets will be impaired, then because of that insurance also you might have to claim additional liabilities because of that, and going concern issue also will be there. And also, yeah, that's it. So now let us move on to the cryptocurrency, our first current issue. Okay, so cryptocurrency, as you know, the definition is it's virtual currencies, something you cannot touch, something you cannot feel. Okay, but it has some rights for the one who is holding that currencies, virtual currencies, it's online. Okay, don't focus too much on definitions and all, you don't have to memorize, but better to know the definition at least. Okay, at least you have an idea that what is a cryptocurrency, because if you don't know what is cryptocurrency, then how will you know the accounting aspect of it? Okay, but SBR is more focused on the accounting aspect. Okay, they are not issued by, these are some features of cryptocurrency that I'm giving you in bullet points. Okay, if you want to know more in detail, please Google and check. And also there are some technical articles, maybe you can go and check it out there. So cryptocurrency is something that is not issued by central authority. It is not like your normal national currency that you have. National currency that you are holding, that is authorized. Okay, it has central authority and government controls it, but in this case cryptocurrency is not central authority and it exists outside the governmental control, which makes it more riskier than your normal currency that you hold. Okay, and one example of cryptocurrency is Bitcoin. You must have heard about Bitcoin. If not, please Google and check. Okay, lots of informations are there on Bitcoin. It's like an upcoming topic now. It's a hot topic. Everyone is talking and gossiping about Bitcoin. Okay, so Bitcoin is something you can use to purchase goods and services, but this is not widely accepted yet. Okay, maybe in future it will be widely accepted. How normally you are having that currency in your hand, you're using it to buy and sell. Maybe Bitcoin also in the future it might become widely accepted, but currently it is not widely accepted. That's why it's in bold. Okay, these are not accounting aspects, these are some features of cryptocurrency, the first slide. Then the market value of this currency is very volatile, extremely volatile, which makes it again very uncertain and very risky for the investors also. That's why, because it is extremely volatile, okay, it can make very high return through short-term trade. See, if it loses, it will lose heavily, but if it makes return, it will make very high return. So there's a huge advantage, there's a huge disadvantage also of the cryptocurrency, of holding this. Okay, so make sure that you know this feature so that it becomes very easy for you to write your answers. Definitely, you don't have to write these points in your answer. It's not needed. So now, because of all this feature, first is virtual currency, second, no central authority, third, it is not widely accepted, fourth, it is extremely volatile, it is not clear cut. The accounting treatment is not very easy for cryptocurrency, but there are some suggestions that has been made. Let us see what is it. Cryptocurrency. Can you take it as a cash? Normally, when you have a currency, what do you take it as a part of a cash, right? For example, Omani Riyal, if you're having it, you say it's a cash. 50 Riyal that I'm holding, it's a cash. Or Indian rupees, or whatever the currency is, the US dollar, the UK pounds, these are cash. But cryptocurrency do not come under cash. First of all, let us reject one by one. What is it not? Before we say that cryptocurrency is something, let us say cryptocurrency is not this, not this, not this. We'll reject and then we'll go, what is it? So it is not a cash. Why? You should know the reason when you say it's not a cash. Remember, saying cryptocurrency is not a cash is not will not give you the full marks. To get that 1 mark, okay, or 2 marks, you have to say why it's not a cash, because it cannot be readily exchanged for goods and services. Let us go to the previous slide. We told that it is not yet widely accepted. So you cannot readily exchange all the goods and services for this. Can you? Can you convert your cash into goods and services? You pay cash and you get the goods and services. Can you do it? Is it readily available? No. For some, yes, but not for all. So you cannot take it as a cash. Second, it does not qualify as a cash equivalent also, according to IS 7. Why? Before you know that it does not qualify as a cash equivalent, you should know the definition of cash equivalent. From where? IS 7. Okay, so it cannot be cash equivalent. Why? Because cryptocurrency is, what did we say in the feature? Extremely volatile. That means it is subject to a significant risk to a change in value. The value will change. And when a value changes, the risk is very significant. If it was not significant, then yes, we can say it's a cash equivalent. But in this case, no. Third, it is not an investment in equity also. Investment in cryptocurrency, you cannot take it as an investment in equity also of another entity. Why? Because you do not have any contractual right to receive cash. Do you have? No. So because you do not have the contractual right to receive cash, according to IS 32, it does not meet the definition of financial asset. To be a financial asset, you have to have the right to receive cash. For example, your receivable. From your customer, you have the right to receive cash from them. That's why it's a financial asset, but not cryptocurrency. According to what? IS 32. That is your financial instruments presentation. Now, so 3 we have rejected. It's not cash equivalent, it's not equity or financial asset. then what is it? Then what is it? This is not very correct, but yes, out of all, the best is IS 38. Okay, this is most applicable for IS 38, this cryptocurrency. That means we can take it as an intangible asset. Why can we take it as an intangible asset? Because it is identifiable non-monetary asset. Correct, right? It's non-monetary asset and you cannot touch it also. No physical substance is virtual currency. So IS 38 looks somewhat okay. So in your answer, when you are given something on cryptocurrency, remember current issue is something which is very easy to answer and score marks. Trust me on this. It's not very hard. The way students think about it, they have made this perception that current issue, oh my god, I should know about all the latest updates. See, you can use a textbook. It's already there. Okay, current issue, when they talk about current issue, they will not give you something very uh, which is not there in your textbook. Most probably they always give you that they have given you in the textbook or technical articles they issue. So read those are enough. Okay, so cryptocurrency they can give. Okay, it's a very good example. So if cryptocurrency is given, the things that you have to write on current issue is very less, not like your other standards that you are studying which are so much detailed. Current issue is very small. If you come to see the points that you have to write, if you know the exact points, you can write on it. You just have to be aware that what exactly which current issue is given to you. Okay, that's it. So if cryptocurrency is given, it's very easy for you to say it's not cash, it's not cash equivalent, it's not equity, it's not financial asset, it is intangible asset. If a question comes whether cryptocurrency has to be, I think I remember a question from your revision kit only in latest past paper. I don't remember the year. I have done a question on it, so I remember it. It was about a cryptocurrency only. That cryptocurrency has to be categorized as what? Equity or sorry, something financial asset or an intangible asset. So there it was said that intangible asset. So where does that answer come from here, from your textbook? So this shows that revision questions, the questions that you get are mostly from your textbook, Kaplan or BPP or anything. It stems from there. Okay, the notes are there. Please use. Now, remember, just because we say IS 38 does not mean it does not have limitations. This limitations also you have to know, because the thing is, it's in issue. Issue means problem. Problem will be there. Okay, so even though most likely it is within IS 38, still, if when we come to the measurement model, this standard is not appropriate. Measurement models mean what? See, intangible asset we can measure. There are ways, different ways, right? We have a choice. So that measurement model is not suitable. Let's see why. Number one is fair value. You can measure your intangible asset using fair value, right? But fair value of cryptocurrency, can you find out? It's very volatile. We told already in the first slide, cryptocurrency is very volatile. So finding fair value also will be very hard because fair value will keep changing rapidly. So in this case, fair value model is not a good model. You have to use cost-based measure. Sorry, I'm sorry. Fair value cryptocurrency, yes, it's difficult to find, but still, because it is volatile, your cost-based measure is unlikely to be relevant here. You cannot use cost-based measure here because fair value is changes very rapidly, very different to your costs. If it was not volatile, then okay, we can say use cost-based because it's very much similar to the fair value. But in this case, cost-based measure is not a good measurement model for cryptocurrency because fair value is very volatile. Then coming to the revaluation model. Fair value means revaluation model, right? Revaluation model is more appropriate in this case. But again, what about the gain on that remeasurement to fair value? This has to be presented under other comprehensive income. Okay. Normally, whenever we have any gain on remeasurement to fair value, it is recorded where? Under other comprehensive income only. But when it comes to cryptocurrency, what is the feature of cryptocurrency? Many entities they invest in cryptocurrency for a reason. They don't keep cryptocurrency for long term to see whether they are getting any profit or not. No, they invest for the short term to get short term value, to benefit from short term. So if there is any change in the fair value in the short term, during that short term they benefit. That's the reason why, okay, when you're benefiting something over a short period of time, okay, so any changes in the fair value, okay, whether it's a gain, whether it's a loss, because it's on a short-term investment, normally it is recorded under profit and loss. Okay, from where are we seeing this? From IFRS 9 point of view. Now do you see why I need the understanding of specific standard to answer current issue? Because if you're not having an issue understanding of a standard, standard properly, you will not be able to answer current issues. It will become very difficult. Okay, don't think current issue is something out of your standard. Without that, you can just answer. It's just something to write. No calculations. It's not like that. To answer cryptocurrency, I should know the rule of IS 38 also in this case and IFRS 9 also. Okay. So assets inside any investment that you are making, right, in cryptocurrencies, like an asset only, right? So assets inside the scope of IFRS 9, which is financial instruments, that you record under profit and loss. But IS 38, normally you record under other comprehensive income. So can you see that it's clashing, right? Now, initial coin offerings. Maybe I'm going a little bit too fast, but if you want, you can go slowly, have pause, write your notes again, come back, right, rather than seeing everything in one go. So otherwise you can see the whole video and then come back and write your notes. So anything, it's up to you. Now we are coming to the second current issue, which is initial coin offerings. We are done with the cryptocurrency. This is a bit easier. It's not so lengthy like cryptocurrency. So initial coin offering, what is it? You should first know what is it. If you want to know more about it, Google is always there, your friend, your best friend, right, to help you out. Okay, so this is a method of raising finance through cryptographic asset. Okay, you raise finance through cryptographic asset. It's like a way of raising finance. This is just the definition I'm giving. This is not to do with accounting as well. It will be in the second slide. Because you should always know the general definitions, the features of a thing before you go deep dive into the accounting aspect of it. So investors, what do? How do they use it? They sometimes call supporters to buy into this. Investors, they call supporter, they tell to buy the initial coin offering, that is ICO, okay, and they receive token in exchange. If you see that this method is very similar to the crowdfunding. What is crowdfunding? Where you call the crowd, okay, to buy and then you receive the fund. Okay, with ICOs originally being used by tech entrepreneurs. This initial coin offering is mostly used by tech entrepreneurs. Okay, it's not used by each and everyone. Small companies cannot use this. They don't. It's used by big hi-fi tech entrepreneurs, right? Next, the tokens received. What happens when the investors receive this token in exchange for buying this one? When the supporters buy the ICO, it gives the holder, okay, it entitles the holder to cryptocurrency when once you receive the token. Okay, so there could be many types of token, like utility token. What is the meaning of utility token? Utility token means it gives access to the product or service. Users will have access to the product or service. Security token means they will have an economic stake in an entity, okay, or they might receive cash in the future. Okay, so this token, okay, this is not something that you receive when you go somewhere, you stay on a line, you get a token. It's not that token. This is very valuable, and this can often be traded on a crypto exchange also, this token. Okay, now ICOs, okay, this is also like your cryptocurrency, unregulated. Okay, so because it's unregulated, companies can have an advantage. Why? They can bypass all the regulated and the lengthy process that they have to go through for raising finance. For example, bank, when you go to bank, have you ever experienced when you have gone to a bank and when uh, you want a loan, right? You are requesting for a loan. How lengthy the process is and how much of information the bank asks from you, and is very regulated, right? So who will stand in that long line giving all the information when it's tightly regulated? Rather, you will always choose which is something which is very easy for you to bypass all this and quickly get it. So in this case, ICO is helpful for you. But remember, it has its own risk because it is unregulated. Okay, so companies often go for it because it is to save time. Next, what happens when an entity raises funds in this way through ICO? This is the very important part, the second bullet point. You will debit. Okay, whenever you are receiving an asset, it will record the receipt of an asset as a debit entry. So that receipt of an asset could be anything. That asset could be cash. Maybe you are receiving cash. Maybe a different cryptocurrencies such as bitcoins. It could be anything, cash or cryptocurrency. So that you receive as a debit entry. For that debit entry is there. But what about the credit entry? When something is debit, somewhere it has to be credit. Where is the credit? There is a consideration in determining the credit entry. Okay, there is an issue with this credit entry. It's not easy. Debit entry, okay, you receive cash or cryptocurrency. Debit credit, there is an issue. There are possibilities that you might record one of this. So the credit entry that you are going to put depend on the nature of the token that are issued. So these are some possibilities. One, financial liability. Maybe you credit in as a financial liability. When do you do that? When the reporting entity, they have an obligation to deliver the cash to the holder of the token. Okay, then it's a financial liability. Or you can credit under equity, credit as an equity. Okay, in this case you don't have an obligation to deliver cash, but you may be entitled to payments out of the distributable reserves. Okay, this could also come when it does not have any contractual obligation to deliver cash. Okay, so if it's not a financial liability, by default it's an equity because you don't have an obligation to deliver cash. Or it could be out of this also, it could be a revenue also. Remember, you don't have to exactly write that this will be this. Okay, you just have to point out those things in your answer, that this could be this. So revenue also. How can it be a revenue? If the recipient was a customer and if a contract is there, if a contract exists, okay, and if the recipient is a customer, then it becomes the revenue from contract with customer. Then revenue you have to apply. Then it's a revenue. You credit it as a revenue. Sometimes it could be none of the above also. So what are the four things that we went through? Financial liability, equity, revenue, and none of the above. Okay, none of the above. For example, okay, if there is any legal or constructive obligation, okay, legal or constructive obligation to the subscriber, then you record it as a provision under IS 37. Okay, then you recognize a provision. But if entity says that no specific IFRS standard applies to these issued tokens, okay, because how do you know which standard to apply for issued tokens? Are there any specific standard that says that issued tokens has to be accounted like this? No. So if IFRS says no IFRS standard applies there, then you have to refer to IS 8. Why? Because IS 8 means changes in accounting policies, estimates, and error. So this could be a change in accounting policy. Okay. In order to develop an appropriate, because there is no specific IFRS standard, that means you have to develop some accounting policy for those issued tokens, right? For that, you have to use the guidance from IS 8. So IS 8. Okay. You have to make a reference to the conceptual framework also. Because remember, when do you have to take the help of conceptual framework? When no specific IFRS standard is there for a particular thing. Just see whether there are any similar standard that is dealing with this specific issue or not. If not, then you have to refer to the conceptual framework. Conceptual framework is like your last resort. So don't forget this order. Now, if you want to know more about this initial coin offerings, you can read this following articles about cryptocurrencies and ICOs. There is a technical article. Okay. One is on cryptocurrency, the other one is on ICOs. Okay. But this is written by the SBL examining team, that is your strategic business lead examining team. Okay, it is not written by your SBR, but still you can use it for the SBR for this paper. It's relevant. And you can go to this website. the site will give you the information. Okay, make sure that you note it down and do go there and check it out. Now we are moving to the third most important current issue. Okay, natural disaster. This is also a very common current issue that can come, and very recently the world has experienced a natural disaster known as COVID-19 pandemic. Okay, so this is just a definition. Okay, natural disaster could be anything: volcanic eruption, earthquake, drought, tsunamis, flood, hurricanes, pandemics, right? Very recently we are still facing the side effect of it, right? So companies, when they suffer this natural disaster, we all know it takes years for them to recover, years and years. Sometimes it never recovers also. So because of this, it has some issue on the financial reporting. Some consequences are there. What are these consequences? We have to see those things. So there are some topics. I've highlighted it for you. I've explained it in the heading, the topic also. Before I went through this, that impairment is one of it. Impairment. It will affect impairment. How? Because of natural disaster. Any natural disaster. It could be anything. Because of this is a indicator. It will trigger an impairment review. Most likely, asset will be impaired because of a natural disaster. For example, a tsunami came. All your buildings are swept away, right? So your building, whatever the asset was there, it is now impaired. Mostly relating to physical asset like property, plant, and equipment. So according to IS 36, okay, this natural disaster is an indicator of impairment. If this exists, means it's an indicator of impairment. Okay, because maybe the individual assets are damaged, or as an economic consequences, because of this natural disaster, it reduces the decline in the customer demand. It does not matter whether your individual asset is damaged or customer demand decline. Both of these are indicators of impairment. If any one of this is there, it is a sign that your asset has impaired. Okay, and we have very recently saw that because of pandemics, a lot of customer demand for the hotels, for the tourism reduced. No one wants to go out. Everyone is social distancing themselves, right? All the classes are now online. No one is conducting any physical classes. So demand for the physical classes ended. So it's an indicator that, the schools, the buildings, they are impaired now, right? So if PP is destroyed, then this should be de-recognized rather than impaired. If your property, plant, and equipment, if your asset that you're holding is totally destroyed, it's not left, nothing is left, then you cannot say it's impaired. Then you have to de-recognize it. It's not there anymore. Okay. Coming to the next again is impairment. Okay. So this asset could be anything. It could be a financial instrument also. If it's a financial instrument, then you have to delete according to IFRS 9. Then you cannot use the IS 36. Okay. How do you know it's a financial instrument? For example, entities that lend money. You as an entity, you are lending money to someone else. So when you're lending money to someone else, because of this natural disaster, now their credit worthiness will suffer. That your the person whom you have lended, the borrower. So because of that, now there's a risk whether he will be able to pay you back or not. The credit risk might have increased now. Okay. So if the credit risk increases very significantly, it means a financial asset has become credit impaired. Okay, most of the time natural disaster is likely to lead to the higher default rate. Your customer or the one whom you have lended money is going to default. The chances are very high. Okay, so this means financial asset become credit impaired. Okay, and then next, what about inventory? Because of natural disaster, your inventory in the warehouse also gets damaged. For example, rain came and all your inventory damaged. Fire came, your inventory got damaged. Then because of this, okay, because of this, what do? You sell the inventory at a reduced price now, because you cannot keep on having the inventory in the warehouse anymore. It's risky. maybe there's a risk that a fire will burn all the inventories or rain will wash away. So before that you're selling, or after that also whatever is remaining you're selling at a reduced price. You cannot sell it at a higher price now. So because of this, according to IS2, inventory now has to be remeasured from its cost to its net realizable value. Okay, now let us go to the insurance. So natural disaster, because of it, will have an impact on the insurance also. We all know when rain happens, what happens. Sometimes your car is washed away by the Wadi, or maybe your car is okay, but it's not working now, it's not starting because the water went inside the car. So what do? All the cars are lined up in the insurance company. Everyone is claiming insurance now. It's now lined up. Very recently, this has been experienced in Oman, where I am currently staying, in the Muscat area, right? So now all the car companies are there in the insurance. They're claiming for the insurance. Okay. But remember, claiming insurance, this to see how much insurance you are getting, this is a very difficult area because it's very uncertain. It depends on so many things. First of all, what is the nature of your claim? And also the type of coverage also that insurance is going to provide. And also the timing and the amount of any process that are recoverable. These are very difficult area to know with certainty. Then IS 37. Okay. IS 37. How IS 37 and insurance are linked? According to IS 37, it says that you can recognize an asset, okay, from an insurance claim. Why an asset? Because from insurance claim you're receiving cash, right? The amount that you are receiving, whatever you have lost, you are recovering it. Maybe partially, maybe fully, it does not matter. But whatever the amount you are receiving from the insurance claim, through insurance claim, you recognize it as an asset according to IS 37. But only if it is virtually certain. If you are virtually certain you're going to receive it from the insurance claim, then only you recognize it as an asset according to IS 37. That means contingent asset. Otherwise, no. Otherwise, what do? This is a high threshold of probability, and so recognition is unlikely. Okay, that means for this to happen, you need a very high probability that this is going to happen, and most of the time, this is very unlikely to happen. That's why you do not recognize it also, right? But if insurance, there's a probability that you are going to receive the insurance claim, then a contingent asset can be disclosed. Most of the time it's not virtually certain, therefore you do not recognize, but at least you can disclose even if it's deemed probable. It looks like there's a probability. It's not, you're not very sure, you're not very certain, but probability is there, you might receive the insurance claim. Then you disclose it as a contingent asset, that insurance claim, according to IS 37. You see how my knowledge of IS 37 is helping me to answer this part of current issue, which is natural disaster. Now we are going to the moving on to the next aspect of natural disaster. This is going to have an impact on the additional liabilities also. Additional liabilities, whenever we talk, it again comes under IS 37. Okay. So because of this, an entity might decide that they are going to sell or they are going to terminate their line of business. Why? In order to save cost. Most because of this COVID-19, you see how many examples are there. How many businesses has been they sold off, right? Why? In order to save costs. Okay. They or to save costs, what are they doing? They are reducing their employee. So according to IS 37, a provision has to be recognized for this. Why? Because now there's a present obligation from the past event. What was the past event? You were having a business. That was a past event. Now you have a present obligation that you have to give redundancy cost to your employee. It's an obligation. So because of that, you have to recognize a provision according to IS 37. Okay, but an obligation, you just cannot say there is an obligation. Obligation only exists if there's a restructuring plan, if there's a plan that is formalized. Everyone has been discussed. Publicly, you have announced that this is the plan. We are going to restructure. We are going to terminate the business. We are going to sell some of the, we are going to terminate some of the employees. Proper plan has been made. You have discussed it with the affected employees and all the people. Publicly you have announced it, then you can say there is an obligation. Then you recognize a restructuring provision. Okay, so when you're measuring the provision, only the direct cost from the restructuring you can take as a provision. What are the direct examples of direct costs from restructuring? One is employee redundancy. Definitely, when you're going to restructure, the first important area that is going to be affected is employees. So you have to give redundancy. You have to make them redundant, the employees. So this is a direct cost. Because of this restructuring, only this cost is there. Otherwise, it would not have been. It would not come into the picture. So this employee redundancy has to be included. Okay, as a provision. Then, what about the provisions? There could be provision if there is any requirement or an obligation to repair environmental damage because of the natural disaster. Maybe there's some environmental damage that took place. Now you have an obligation to repair that damage. So because of that, you have to recognize a provision. Okay. Moreover, a decommissioning provision. What is decommissioning provisions? When you have an obligation to decommission an asset, you don't use the asset anymore. You bring it to the original position it was before you use that asset. For example, you have decided that you are going to build up a place or a factory or something for 4 years or 5 years. Once it's over, the purpose is over, you decommission that factory. Okay, and you restore the land. You bring it back to its original position before it was a land. So if there is an obligation for that, you have to recognize a decommissioning provision also. Okay, so this will require a review. You just cannot recognize decommissioning provision. It's a bit hard. You need to review this. A review is required. Why? Because natural disaster may change the timing or the amount of required cash flow. Because of this natural disaster, now it might take more time for you to receive, or you might need more cash flow now. Right? It will change the timing also. So you have to review all this. Now, going concern, very important areas. Going concern, because of natural disaster, it becomes more hard that you're going to survive also or not. So because of this, it has an impact in your IS1. Okay, additional cost came. There is some business interruption and is there. Okay, because of this, maybe your bank loan is breached. The bank loan covenant is breached. Okay, so if there might not always be a going concern issue, but if there are any material uncertainties, then you have to disclose this in accordance with IS1. Okay, if the going concern assumption is not appropriate, then you have to prepare the financial statements on an alternative basis. You cannot make the financial statements on a going concern basis any longer. And the fact that you're not preparing it under going concern assumption, you have to disclose it. Okay. Now let us go through test your understanding 1 to better understand this scenario of the current issue. This is relating to a pandemic. How pandemic can have an effect on the fashion industry. Okay, let's go through test your understanding 1. Test year 1 covers question on natural disaster, which is a current issue, and how it is going to affect your financial statements. Okay, so let's read. Middle Shop operates in a fashion retail industry and has a year end of 31st December 2001. It owns 15 stores all located in one country, and they are using cost model under IS 16 due to an international pandemic. The government of the country in which Middle Shop operates required all non-essential retail and hospitality outlets to close the several months during 2001. It is anticipated that further closure will be mandated throughout 2002 until an effective vaccine is developed and rolled out amongst the population. So when you read a case study like this, you need to understand what is it. It's a current issue. What type of a current issue? There are 3 current issues that we have gone through. Okay, out of the 3, this is the natural disaster. This current issue is what? Natural disaster. Natural disaster could be anything, right? Such as pandemic. Because of this, there are impact on so many accounting standards. Okay, so you need to know which places it's going to affect. We have seen previously what are the standards it is going to affect. Now we are going to use it in this answer. Okay, so it has more. So here the pandemic has a negative impact on the fashion industry. Wait. So it has a negative impact. Demand for the new clothing, definitely it will decline because of the lockdown. Okay, and also there has been an intra-house household socializing, and also the increased uptake of home working, because now everyone is working from home, no one wants to work outside. So anyway, new clothing demand will decline, and because of this unemployment also increased. Okay, so I'm not reading word by word. Okay, the main things I'm just picking out from the case study and highlighting it out for you. Okay, so if you see, even their footfall was far lower than the previous year. That means consumers expenditure reduced. Okay, because they choose to shop online. Okay, now they sell online through their website, but the functionality is poor, and also the customer uptake is low, and this website is recognized as an intangible asset and amortized over 5 years. Okay, now they want to go for some larger stores, but no firm's plan have drawn up. That means they want to expand, but there is no firm plan. Okay, and also there has been some operating losses which is being expected in 2002. The data wish to provide for redundancy cost and future operating losses. Okay, you have to explain whether it is appropriate to do so or not. They also have some bank loans which are repayable within 12 months of the reporting date. So there are effect on so many places: bank loan, the operating losses, the intangible asset. Okay, discuss the financial reporting implications for the above in the middle shops. Financial statements for the year ended 31st December 2001. So whenever you are given a current issue, they will give you some form of a current issue. They will not give you all the current issues, maybe one. Okay, out of the current issues that you have learned, only one current issue they will give you. Okay, in this case you need to understand. Okay, they will not tell you specify this is the current issue, this is the current issue, no, this is the cryptocurrency, no. Looking at the case study you will understand this is more like a, it falls under natural disaster. It is not a cryptocurrency, and it is not initial coin offerings. It is what? It is a natural disaster. Okay, so natural disaster we have seen previously what are the impact it has on different races. So now let us see the answer. Okay, what is the impact it is going to have? Okay, each standard you can explain in separate paragraph. For example, first paragraph talks about IS 36. Okay, IS 36 is means impairment. How do you know it's an there has been an impairment of assets? See, whenever there is some natural disaster, okay, asset will impair. Okay, most probably this will have an impact on the impairment of assets. Value of assets will go down. How do you know? From the case study. You have to give some evidences from the case study that impairment has taken place. You just cannot say generally, okay, impairment of asset, this is how you do impairment of asset, uh, carrying amount less recoverable amount. No. Things like economic downturn. We saw that economic downturn was there, and also there were some periods of closure. They are closing some of the shops, some of the stores. So that shows that these are the indicators of impairment. These are indicators. Shop are closing down, economic is going in downturn. Okay, also there are some more. For example, for intangible asset, they told website is an intangible asset. For that, poor functionality, it's not functioning properly, and also the use is not so much of that website. This is also means it's impaired. So you see, we are referring it to the case study. We are linking IS 36 with the case study. Okay, IS 36, you have to go through the standard IS 36 is there up in my playlist for SBR lecture. Because current issue, this is the last lecture, last topic. So you have to be thorough with all your previous standard. Once you come to current issue. Current issue is the last lecture. In your textbook also, if you see, that is the last topic to be discussed. Okay, after this, we are directly jumping into the questions from your textbook. After this, no more lectures are there. After current issue. So IS 36. Okay, what does it suggest? Whenever there are some indicators of impairment, it suggests impairment reviews must be carried out. Correct? Okay, so this means impairment review means you compare. Whenever you talk about impairment, you have to talk about certain words like carrying amount has to be there in your answer, recoverable amount has to be there in your answer. This words has to be there because this is the meaning of impairment. You're comparing carrying amount with the recoverable amount. Okay, so in this case you cannot test individual assets for the impairment, is it? It's unlikely that you can. So what do you need? You need CGU, cash generating unit. You need to test this as a part of cash generating unit. It may be that each store is a cash generating unit. So any impairment of assets, where does it go? Remember, you are talking about the financial reporting implications. So you need to talk about which places it will have an impact. So any impairment of assets, where do you record? In the profit and loss account. Don't forget this part. At the end of the paragraph, you should be able to tell which point, which place in your financial statement is it going to affect. So impairment will be recorded in profit and loss account. Because of that, we know losses, expenses will go up and profit will go down. But no need to write losses will go up, profit will, it's understood. Okay, starts to profit and loss is enough. Second paragraph talks about intangible assets, that is IS 38. First it's only about impairment. Now this order you can choose in any order, the way you want to write, whether you want to write first IS 38 then IS 36, or there are other standards also. Okay, total standard, if you ask me, there are total 5 standards. Okay, one is IS 36, that is impairment. IS 38, this is because of natural disaster. IS 2 inventory, IS 37 and IS 1. So if you see 5 places, 5 standard and 5 different paragraphs you need to talk about. So second paragraph, this is over. Now we are in IS 38. So IS 38 is intangible assets, same. For intangible assets, what do? You have to do an annual review for the amortization. Okay, so already they have given the amortization for 5 years. Do you think it's appropriate? For the website, see, intangible asset, what is the intangible asset? You always need to understand in your question, whenever intangible asset is there, what is the intangible asset? Here in this case, website is the intangible asset. So for website, they have told that amortization period is 5 years. So this useful life is too high. For website, 5 years is too high. If it was some other assets, intangible assets, okay, 5 years we can understand, but website, 5 years too high to amortize. Why? Because it requires some replacement in the near future. Very recently only, I mean upcoming in the future, which is not very far, you need replacement. So 5 years is too long. Okay, so that means this 5 year needs to be changed because of this natural disaster, this pandemic. Whenever some pandemic hits, what happens? Your useful life becomes shorter. Okay, because now you need to replace it more. Because of natural disaster, it might have got worn out or some became obsolete or whatever it is. So in this case, this needs to be changed. So because of that change, where do you recognize the change? Whether it is change in accounting estimates, policies or error, it is under IS 8. Okay, I forgot to mention IS 8 is also there. Okay, I will write it here. IS 8. So 6 standards are getting affected just because of one current issue, which is natural disaster, which is in this case the current pandemic, the COVID-19. Okay, make sure that you have the latest textbook with you, because this is the latest textbook. Okay, latest textbook only has this example of pandemic. Okay, before this you will not have that. So anyway, starting with this, so IS 8. Okay, you need to understand what is amortization. Remember, IS 8 talks about 3 things: policies, estimates, error. Amortization is an estimate. Amortization is an estimate. You need to understand this properly. Amortization, depreciation, these are estimates. These are not policies. And there has not been an error also in the past. Okay? Please understand the difference between a policy and an estimate. Okay? You estimate the useful life of amortization, 5 years, 4 years. So it's an estimate. Okay? So if you change this, how are you going to deal with this? Prospectively. That means in the future. You are not going to change your past. Whatever is recorded in the past is recorded in the past. That means current and the future period. You will change. That's the impact. Now let us go to the third, which talks about IS2. So this is also over. This is also over. IS 237 and one are left. IS2 inventory. Because of pandemic, inventory will get affected. Why? There's a decline in the customer demand. Because of this decline, inventories will increase. Inventories will keep increasing because no one will buy your inventory. Fashion industry, right? Clothing industry, it will have inventory. Pile of clothes will be lined up in your inventories only. Surplus inventory, but no one will buy. Okay, and how do you measure inventories? Very simple. IS2 is very simple. At lower of cost or net realizable value, that's it. You need to know about IS2. So now you have this surplus, you need to sell it out. You cannot keep on building your inventories. How are you going to sell it? You can sell it for 0%, you can scrap it, or you can 0%. Okay, just sell it free or sold at a heavy discount. Give 80%, 70%, 50% heavy discount. Okay, what does it? What is the result of this when you're doing it? Your net realizable value will fall below your cost. Okay, your net realizable value. Anyway, you have to see the lower of cost or net realizable value. It will be at net realizable value only, but this will fall below your cost. It will fall. It will become very low because of this. So because of this, it's an expense. It's kind of an expense only for you. What you are doing to sell that excess surplus or having that excess inventory. It's an expense only. So this expense, okay, will be recorded in profit and loss once again. Because you have to remeasure your inventory because of this. What is the impact? Inventories will be remeasured now because of this pandemic. This, and it's an expense which will be recognized in profit and loss. Now, so this is also over. IS2 is also over. Now let us go to IS37. Provisions, contingent liabilities and contingent assets. Okay, this a provision will be recognized in this case. But give the definition. If there's a present obligation from the past event, because of that you will have a probable outflow, then and it can be measured reliably, then you have to recognize a provision. So in this case, you have to see whether there's a provision obligation or not. There is no obligation. No obligation to pay redundancy. Are you obliged to pay redundancy? No. How do you know whether you have an obligation or not? It's very simple. There are no formal plan or no detailed restructuring plan. Whenever there is no detailed restructuring plan, that means there is no obligation to pay redundancy and you do not recognize it. Simple. Okay, the detail of this, if you want to know, you have to go back and revisit your IS37. IS37 is very important standard. You anyway need to know it. Okay, there is no doubt whether it will come or not. It will definitely come in your exam. It can come in any question, 1, 2, 3, 4. Out of it, any question in any part, IS37 will come. Or maybe it will be hidden in some other standard, bigger standard, but IS37 will come. Okay, I've never seen a question where IS37 is not asked. So IS37, we're very prepared for it. Maybe other standards like IS2 and this standards might not come very regularly, but IS37, yes. And whenever you are applying this standard, always think this is a current issue, pandemic. Okay, or you can name it under natural disaster, the main topic. So this you do not recognize. Sorted. That redundancies. What about the future operating losses? This also there is no obligation because they can avoid these operating losses. How? By choosing to cease trading. Because they could choose when you can avoid it, you have no obligation. Obligation means what? When you cannot avoid it. It's like a bank loan. The interest that you have to pay on the loan. Can you avoid it? No. Can you say that I'm not going to run this business? I don't want this loan now, so I don't have the obligation to pay the interest. You cannot say that. It does not matter. Whether you make losses, still you have to pay the loan, the interest. That is the meaning of obligation. You cannot escape. You cannot rescue yourself. But in this case, you can. How? When you cease to trade, when you stop trading, you will not make any future operating losses. So that means you have no obligation to provide for future operating losses. Okay, the detail is there in IS 37 for future operating losses. You can read it to better understand this. Okay, so in this case, okay, finally give a conclusion. In this case, middle shop, they cannot provide for the redundancy cost also, future operating loss also. Simple. Now, last, IS1. How IS1 is going to be affected because of this pandemic? Because when there is an economic downturn, and that means they will not have any sufficient cash to repay its short-term bank loans. Remember, they have taken some bank loans at the end, and 12 months they have to pay short-term bank loans. That's me. So they will not have sufficient cash to pay. Because of this, there will be an uncertainty over their going concern. Because of this, it will affect your IS1 also. Okay, and this must be disclosed. So this going concern, this has to be disclosed in the notes of the financial statements because of this pandemic now. Okay, so this is the way how you solve a current issue question on a pandemic or natural disaster type of questions. So that's it for test your understanding 1. Now let us come to the second topic after the 3 current issues that we have discussed previously: cryptocurrency, initial coin offerings, and natural disaster. Now we are moving towards materiality. Okay. So under materiality, we are going to go to the practice statement. What is practice statement? How it looks like. Okay, so under practice statement, how do we recognize and measure the materiality we're talking about already? Okay, so this already talks about the materiality aspect. Presentation, how are we going to present and disclose the users of this process? What is the process? So these are the following steps that we are going to cover: recognition, measurement, presentation, disclosure, users, and process. Now let us move on in the detail. So the practice statement. What is practice statement? The board have issued this practice statement called making materiality judgments. Okay. So this provides a non-mandatory guidance. This is a non-mandatory guidance. It's not mandatory. Okay. It's your choice that you can use this guidance, which helps the preparers, the one who is preparing the financial statements when they are applying the IFRS standard. This helps. Okay. This guidance. So through this, preparers are getting guidance. Okay. Practice statement, which is named as making materiality judgments. Make sure that you know these terms, okay? Because there could be many practice statements, but for your exam, they are giving you making materiality judgments. Next. So when you have to assess whether information is material or not, okay? I'm sure that all of you know what is the definition of material. Okay, definition of material is, if you don't know, okay, in briefly, the definition is that if you're omitting or if you're trying to hide something, you're concealing some information from the financial statement, the impact, okay, the impact is very significant. That means the decisions that the investors are going to make based on that, once you omit that information or you are concealing that information, could be very significant. That is the meaning of material. Okay, it could change their decision if those information would have been included. So that's just the definition. Okay, so here entity should consider two things. One is quantitative factor, one is qualitative factor. You have to see both the things when you want to decide whether this information is material or not. Quantitative factors like the threshold which is given to you, such as measures of revenue, profit, assets, and cash flows. I suppose it's 1% or 5%. Okay, some quantitative factor is there. Okay, then qualitative factor also you have to see. For qualitative factor, whether it's a related party transactions. If it's a related party transactions, revenue. Where do we study related party transactions? With standard? IS 24. Yes, IS 24. Unusual transactions. If it's unusual, it's most likely that is going to be a material thing. Okay. Geography, you see based on the geography and wider economic uncertainty. Okay. And so materiality judgments, these are very relevant. When you're making, see, materiality, when you have to include information, you are using judgments only. It's not something very objective. That's why this is very important area that is covered separately. So this judgments you have to apply in 4 areas, or let's say 3 areas. One is in the recognition area, when we have to recognize, when you don't have to recognize. One is in the measurement, how are you going to measure, and presentation and disclosure, how are you going to present it. So in these 3 areas, you are using their judgments. Practice statement. Okay, Everything is under practice statement only when we talk about materiality. So recognition and measurement. How do we recognize and measurement? This is a very important area. Definition of materiality, all those things is not so important. Okay, important is from here onwards. Okay, so they only need to apply recognition and measurement in an IFRS standard when effects are material. For example, when you decide that under specific IFRS, let's take IFRS, which standard should I take? Give me an example. Okay, let's say IS 16, property, plant, and equipment. When you decide, how do you decide whether you have to include this asset or not in the financial statements? So even in the recognition, even in the measurement, when you feel that the effects are so material, you include it. You recognize it also, you measure it also. So in that recognition and measurement criteria, in that specific IFRS standard only it is given that it has to be material, then you include. Okay, so this is an example that is given. Exactly the same standard that I have just explained you, IS 16. Okay, so where you recognize the cost of an asset as the cost of an PPP as an asset. Okay, but sometimes what happens is to save time, the entity decides that no, the expenditure which is below $1,000 for a fixture and fitting will be taken as a profit expense under profit and loss, not as a asset. Okay, so this way also you can do, but the impact of this policy, if the impact is not material, if you excluding 1,000 and below 1,000, you take it as an expense. If this does not have a material impact, yes, sure, you can go ahead. Otherwise, you cannot do it this way. Otherwise, you still have to comply with IS 16. That means you have to recognize whether 1,000, whether 10,000 as an asset only. Okay, for recognition criteria we're talking about. This is just an example. Now let us move on to presentation and disclosure. So recognition and measurement part is over. Presentation and disclosure. Here also, it has to be material. Then only you present. Okay, you don't present each and everything. Okay, in an IFRS standard or an IS standard, anything. Okay, IFRS standard does not mean only IFRS standard. It could be an IS standard also. Okay, but remember, the entity sometimes they need to provide some additional information which is not required by an IFRS standard. Why? Why do they need to provide that additional information? Because it is very necessary. Okay, sometimes that additional information will help the user, financial statement user, to make a decision. Okay, sometimes because of that additional information they can understand the impact that that financial transaction is having on the financial statement during that period through that additional information for the user. So that time you have to disclose it. That time you cannot say, okay, this information I will not include because it's not material. No. Example is this again, IS 16. So IS 16, sometimes they might tell you, okay, disclose the entity's contractual commitments to purchase the property, plant, and equipment. But if this commitment is not material, then do not disclose it. Otherwise, disclosure is required. Presentation and disclosure once again. So when you're organizing the information also, you have to see these things. Entity should do it in this order. You emphasize the material matter. The most material matter should be the first one to be disclosed. You just do not present and disclose in any order or any way the way you want. No. Most material will be in the first, the least material will be in the bottom. Then ensure that material information is not obscured by immaterial. You always have to check that material information is not hidden inside the immaterial information. That means you are giving too much of information which is not very important, immaterial. So your material information also you are giving, but it is hidden under the immaterial. So we do not understand what is important, what is not important. Too much of information. So you should not do that also. There should be a balance. Ensure information is entity specific. It has to be for the entity. If it is not for entity generally you are giving, it is not going to help the user to make any decision. When you are giving presenting, make sure that you are presenting in a very simple way. Keep it very simple and concise. Concise means very brief. Do not keep on writing lengthy paragraphs. Okay, but when you are writing it briefly also, material detail you should not avoid. That should be there. Format has to be appropriate when you're presenting, and it has to be understandable also by others. For example, if something has to be given in a form of table, you give it in a form of table or list or narrative. Provide comparable information. When you prepare information, better prepare comparable information so it becomes easier for the users to compare. Okay, avoid duplication. Don't duplicate things. Even though it's material, don't duplicate this things twice. Now we are talking from the point of users, for the user. Okay, so when you're making this materiality judgments, most of the time you see this based on who is your user, who is your primary user of the financial statements. From their point of view, what will they consider material? You think like that. Then only you make that judgment. Who are the primary user? Mostly it is your investor, the potential investor, and your creditor, and the your bank, the one who is giving you finance. These are very primary user. There are so many other stakeholders, but these three are very primary. Okay, your creditor, your bank, and the shareholder, the investor, the potential investor. Okay, remember financial statements. Okay, it cannot meet all the informational needs of all the primary user. No, it's not possible. Somewhere someone will be unhappy, some information will not be given. Okay, all cannot be satisfied, but still the aim of the one who is preparing the financial statement should be what? At least the common informational need that is common to all the primary users should be met. Some informational needs are very common. It does not matter whether he's an investor or a creditor or a bank or a customer or a supplier. The need is very common. For example, let's say profit. Everyone wants to know what is the profit of the company, or everyone wants to know what is the liquidity position of the company. Whether it's a customer, whether it is supplier, whether it is the bank, whether it's the shareholder, whether it's the potential investor, everyone wants to know this. Even the tax department wants to know this. The government. So for this are common needs which has to be given. Some are very specific for specific individual, for specific type of stakeholder. This okay. You don't include it's still okay. Fine. So common, I have given mentioned it also in the bracket: investor, lenders, and creditors. These are the three very primary users. There are other, but whenever we talk about users, mention this three. Okay. This is an example has been given to you. For example, there are 50 investors. All the 50 investors are holding 2% each. That means it will make up to 100%. Okay. Out of this 50, one of the investor, they are having an interest in the information. What is that information need that they want? They want the expenditure in the France. Why? Because the investor operates other businesses in that country. That means this particular investor, out of that 51 investor, is having a business in France. That's why he wants to know the expenditure in France. Okay, so when you're making a materiality judgments for this, how do you make it? You cannot consider the specific informational needs of a single investor. If the expenditure in France is immaterial, if it's immaterial, you cannot say, okay, a single investor wants this specific information, therefore I have to include. No, even though it's a primary user. Okay, for our primary user as a group. So as a group, it has to be immaterial. Then you do not provide it. Okay, now process. What is the process? So the board recommends a systematic process when making materiality judgments. Okay, when you're making judgments, it's not that you make judgments the way you want. There is a systematic process for that. So this is the step. These are the 4 steps. Step 1, 2, 3, 4. Step 1, first you identify that this information is material, or it could be material. Second, what do you do after you identify it? Assess whether the information is actually material or not. So, okay, first you in the first step you'll be having more information than the second step. Why? First information step, it could be material. You're not saying it's material, but there are chances. So you take that, you take this, everything you identify and keep it ready. Once you have identified from those, only from those information, the ones which you have said in step 1 not material, they're out of the list. Only those information which you have considered in step 1 could be material, you take it into step 2, and from there you assess whether the information is material or not. Again, some more will go from the step 2, some more will reduce, and it will become lesser in step 3. Okay, organize the information in a draft financial statements. Before you make the financial statements, the final version of the financial statements, you draft. You do a draft financial statement. Organize those information that you have considered material. Organize it. Step 4, review the draft financials. Then you review and see whether it is in a proper order or not. What is the order? Whether the most significant is included in the first. Have you omitted any material information? Then all these things, okay? Basically all these things, what do you do? These things, this list, when you're presenting, whether it is understandable, whether it is in a table. So those things you see, okay? In step 4, you review. Review means that. So identify, assess, organize, review. Okay, I hope you'll remember the step. It's very easy. Okay, nothing to memorize so much. Now, third, we are moving towards management commentary. Materiality practice statement relating to materiality judgment is also over. So two things are over today. What is it? One is the three current issue: cryptocurrency, initial coin offerings, and natural disaster. Second, materiality judgments when we are making. We went through the recognition and the measurement, the presentation and disclosure, the process, the user. Okay, now we are moving towards the third, management commentary. Okay, very regularly you must have seen this question appears in your exam, right? So under management commentary, we are going to cover this purpose of management commentary, framework for the presentation of how do you present management commentary, and elements of management commentary, providing useful information. These are the four areas that we are going to talk about under management commentary. So let's start with the management commentary. What is the first topic? Purpose. What is the purpose? Okay. Number one, it is not mandatory. Not mandatory. It's your wish. You want to produce management commentary, you do. Management commentary is more like you're making a commentary, some narrative statements. Okay. Then, okay, so the first point came later when I was playing the slide. Sorry. The first point is that the IFRS practice statement management commentary. So this is a second practice statement. Earlier we went through materiality. Now this practice statement covers management commentary. So this provides a framework. So through this IFRS practice statement management commentary, you will know how to prepare and present management commentary. Okay. Then this provides more information, more context. The management commentary. What is the purpose? Why do we need it? Because this provides more information. So through this, you can analyze the financial position, performance, and cash flow of the entity through this because they give you more context. It's commentary, you are commenting. In financial statements, if you see the statement of financial position or statement of cash flow or statement of profit and loss, can you know the reasons why a particular profit is like this, or what could be and what are the impact on the future because of this profit? No, because it is not commented. It is in numbers, number format, and one specific at one specific time. It's like a snapshot at one specific time. Later on, situation even if it changes, you will not know. So management commentary is like it is not a substitute for financial statements. It complements it. It enhances the usefulness of the financial statements. It gives more useful to interpret your financial position, performance, and cash flow. That's why we need management commentary. Okay, but it's not mandatory. Okay, now so we finished this thing. Now we are moving towards the framework for the presentation. How do you present? Purpose is over. Okay, so wait. Okay, again we have the purpose. So the purpose is same, to provide the management assessment. Through this you can assess the position, performance, and progress. It supplements the information that is already there in the financial statements. It explains the information that is there in the financial statements. In financial statements is in number. Management commentary explains it through words. Okay, you can take it like that. It explains the factors also. Why the performance is like this? What are the factors behind this, that the performance or the position is like this? Or what could be the factor that could lead to an increase or better performance in the future? So management commentary does that work. Okay, management commentary, if you see, it's not looking in the past, it's more like forward looking. Okay, whatever information is there, it is forward looking, looking in the future. So that's an added advantage which is not there in your financial statement. And management commentary, they should have the qualitative useful characteristics of the information. What are the qualitative characteristics of useful information? Information should be timely, understandable, relevant, faithful representation, and what is it? What are the other two? You have to be verifiability and understandability. Okay, so those three things are four things, six characteristics has to be there. Even though it's not mandatory, but information still presented in management commentary should have the qualitative characteristics. Now, elements. What are the elements of management commentary? Like how we have elements for conceptual framework in the financial statements, asset, income, expenses. Here also, we should have some element of management commentary. So this include information, okay, that is essential to an under. So this helps you to understand few things better, like nature of the business. You can understand what is the nature of the business. What is the management's objectives and strategies? Their entities, resources, risks, and relationships, and the key performance measure that managers are using to evaluate the performance of the entity. Okay, so often the historical financial statements, they are criticized because they are backward looking and not enough discussion is there about risk. We don't know what is the risk. So historical financial statement is lacking in that area. Because of that, we include management commentary also. So this could be extremely very beneficial to whom? The primary user. Because of this, they can now make more better decisions. Or sell their shares in the entity. Providing useful information. Okay, it's not just any information. Useful information you have to provide. So when you are providing information in the management commentary, known as performance measure, it has to be presented or reported in such a way that it has to be in a consistent manner. Not just 1 year you are presenting some performance measure, second way you are reporting it in some other way. No, consistent manner from year to year. So because of this, over time you can compare the management commentary. You can compare. Second, even with other entities, you should be able to compare that management commentary. Okay, how are you going to make sure that you can compare with other entities? The question is that it could be done if you disclose the performance measure. If you choose those performance measure which are widely used by that industry that you are operating in. If you see that your competitor or someone else is also using the similar performance measure, you also use it. So it becomes more easier for you to compare. You are encouraged to present non-financial performance more into the management committee, because financial performance is already there. Profit, cash flow statement, income, expenses is there already, but non-financial performance including the management commentary. And management commentary, it should not be generic. Okay, so you can say disadvantages of this is that it makes it very hard for the investors to locate that this is relevant information, this is relevant information from the report, because management commentary also will be having so much of information. So because of that also, this becomes it's an additional clutter, you can say. It wastes a lot of time because you have to keep searching what is relevant information from that report. So that's a disadvantage, but nevertheless advantages are more. So now let us go to the test understanding 2 to see a question. How do we do a question on management commentary? So here you go. Test your understanding 2, management commentary. So let's do a question on management commentary. We are given a question on management commentary. How will it look like? This is more descriptive in nature, not it does not have numbers. Okay, it's more like you have to write a lot. Okay, so you need to write how to write, because management commentary, if you see it in simple term, it is more like you're commenting. It's more like a narrative statement that you're making. But how to write specific answer for management commentary, one needs to know it. Okay, so I'm going to show you through this question. Let's read the scenario. The scenario is very small. So the directors of Carsoon are committed to produce high quality report that enables the investors to assess, okay, the high quality reports that enable its investors to assess the performance and position of the business. That means they are worried about the performance and the position to assess. They have heard that the board has published a practice statement on management commentary. However, they are unsure what is meant by management commentary and the extent to which it provides useful information. So now you have to tell them what is the extent that they are going to provide useful information through management commentary. So required, discuss the nature of management commentary and the extent to which it embodies the qualitative characteristics of useful financial information as outlined in the conceptual framework. That means when you're answering this question, two things you have to take care of. Number one, the nature of the management commentary. Number two, the qualitative characteristics. This qualitative characteristics was explained in your lecture 1 if you go back under conceptual framework. You have to talk about the 6 qualitative characteristics and link them with management commentary answer. Okay, so now let's see the answer. This way it becomes easy for you to break down and know what to write exactly in how many paragraphs and what will be the subheading. So subheading, when you're taking, you can just take management commentary. Okay, oops, sorry. Management commentary could be your subheading. You need to use a proper subheading. Keep it short. Now, when you're answering, first start with the nature of management commentary before you talk about this qualitative characteristics linking to the conceptual framework. Follow the order of the requirement given to you. First, they have talked about the nature, then they talking about the qualitative characteristics. So when you are answering also, first talk about the nature, then talk about the qualitative characteristics. So management commentary. We all know it's a narrative report. Okay, so this is a nature. It's a narrative report. It does not have numbers and all. Okay, so through this, okay, it provides a background through which stakeholders can assess the financial position and performance of the company. So number one is narrative report through which they can check the financial position and performance. Number two, it is not mandatory. Second nature is that it is not mandatory to produce this management commentary. It's your wish. You want, you do, otherwise you don't. Not like financial statements where it's compulsory you have to do. So that is the second nature. And third nature, okay, it's not a third nature, it is linked with the mandatory part. If, okay, even though if it's not mandatory, but still if entities do make management commentary, they have to take care of certain things. They should include information that is essential to the understanding of. So when you are including information, is not like just because of its narrative and just because it's not mandatory include any information. No, so there is a scope. There is a extent to which you can include the information. So when you're including any information in the management commentary, take care of this 5 bullet points. It should mention the nature of the business. It should mention the management's objectives and the strategies for meeting those objectives. When you, for example, you say this is my objective. This is the objective. I want to increase my sale by 5%. What are the strategies that you are going to do it? How are you going to achieve that 5% increase? You have to explain it. Third, the resource, the risk, and the relationship. The entity's resources and the risk. What is the results of the operation and the prospect? And the key performance measure, the key performance indicator, KPIs. Because through this only management can evaluate their performance. So this is there in your management commentary. Now there are some more nature. Okay. Another nature is it is forward-looking information. Unlike your financial statements, which is based on your past information, based on historic, this is forward-looking information. It includes something to look for in the future, and it should be entity specific, not generic, not general, very entity specific. The comment should be based on the entity. For example, management commentary will vary from entity to entity. It's not general. Okay. So now this was the nature part. Now we are coming towards the link. How are you going to link this to the conceptual framework? Remember, it's just because this management commentary which comes under current issue does not mean that only I read about management commentary. No, you have to know the knowledge of the conceptual framework also to link this answer. Both the knowledge you need. One is management commentary, on the other hand, conceptual framework. Management commentary you will get from this lecture. But what about conceptual framework? It comes from your lecture 1, which I'm not going to repeat here. Okay. Here you need to know how to link. So what are the qualitative characteristics of useful financial information? That means whatever information you include in the management commentary should possess this 6 qualitative characteristics that was already explained under conceptual framework in your lecture 1. What are they? Let me repeat it. Okay. Relevance and faithful representation, which are fundamental characteristics. The two fundamental characteristics. The other 4 were enhancing, but still they are qualitative because the word says qualitative. The word did not say whether it's fundamental or enhancing. So you have to mention both. That means total 6 will be there. 2 from fundamental and 4 from enhancing. You have to include all the 6 qualitative characteristics. Okay. So the 4 enhancing, it enhances it more. Fundamental means it has to be there. Whether it's enhancing or not comes later. When something is not fundamental, thing is not satisfied. If it's not relevant or faithful representation, then no matter whether it is understandable, verifiable, comparability, timeliness, it will not satisfy the need. First, fundamental thing has to be there. You first have to check whether it is relevant and faithfully represented or not. After these two are satisfied, then you will look for the other 4 enhancing. It enhances it more. Okay. What are the 4? Understandability, verifiability, comparability, and timeliness. It has to be understandable. It has to be verified. It has to be you should be able to compare it and in the time. You have to provide it in the time given. It should not be provided very late for a useful decision to be made, effective decision. Now, it also provides information about risk. So what does management commentary provides users with? Risk management, the risk that you're taking. Okay. And also it shows an extent to which the current performance can be an indicative of the future performance, whether it is in line, whether you have to improve it, whether you are not currently performing well, you can know through this management commentary. Okay. So now we have to talk about relevance and faithful. Now we have listed the first list the 6 characteristics. After that you link one by one, one by one, one by one. First they have talked about relevance. Relevance. How is that relevant? Because remember, management commentary includes forward-looking information. How is it relevant? It is relevant. Why? Because it helps users to make decisions whether to hold or sell investments in an entity. Right? Whether you have to hold or sell, it is based on that information. So therefore it's relevant. Okay. So relevant part is over. Now, to enhance it, to enhance that relevance, what should you do? You have to include material information only in the management commentary. And they should focus on the most important information, material information, and most important. That means generic information is not relevant and this should be avoided. If you are giving any general information, it is not relevant, it should be avoided. Now we are talking about understandability. How do you maximize understandability? You present management commentary in a clear and a straightforward manner. Simple. And make it more understandable. Now, so when selecting key performance measure, remember you have to select some key performance measure, right, for your management commentary. It is not mandatory, okay, but still you have to use those that are accepted and that are widely used within the industry. It should not be something which is created by your own and no one is using in the industry. No, remember you have to be able to compare it with others, so it has to be something which is accepted widely in your industry to use it as a key performance measure in your management commentary. Because of this you can draw comparison, because comparison is a part of this, I think. Yes, see, comparability. You can understandability, already we have talked about this too. Okay, they should be able to measure it consistently also, and thus enabling it to compare from year to year, different years. Now, if there are any information in the financial statement that needs to be adjusted, this has to be included in the management commentary, okay, as a fact, and it has to be disclosed. Because in the financial statements, what are you doing? You're just adjusting the numbers. How do you know why we change the numbers and in what places? It will be there in your management commentary. It has to be disclosed there. So any financial performance measure will be reconciled to the figure in the financial statements. Any changes, any financial performance measure you have talked in your management commentary, this will be reconciled to the figure in the financial statements. So because of this, what happens? They can verify also. So it satisfies the verification also. Okay, you can verify from your management commentary to your financial statements. So they can also assess whether the performance measure they prefer a faithful representation of the entity's position and performance or not. So all these categories are satisfied: faithful representation, relevance, understandability, comparability, verifiability, timeliness, everything. So it satisfies all these characteristics. Therefore, management commentary. Okay, this is how you link it with the conceptual framework. So that's it for test understanding 2. So now let us start with the presentation and disclosure. So under presentation and disclosure, we are going to cover, this is the last part of the video, exposure draft. And under the exposure draft, how are we going to do it? Define subtotals, because sometimes we just cannot put subtotals. Under that, we have to put some subtotals which are required, and we are later going to see in the next slide what are the subtotals. Then disaggregate information. How do you disaggregate information? Okay, there are ways of aggregating, when you have to disaggregate, when you have to aggregate. It's very important when you're presenting. So these are three areas where you are going to disaggregate information, separate information, make it more detailed. So, for example, operating expenses is an area. Unusual income and expenses is the second area, and third area are other issues. Okay. Then the management performance measure. So management performance measure, how do you present or disclose it? And the statement of cash flow, the last. Okay, because through statement of cash flow also you present. How do you present it? We are going to cover it. Exposure draft. So under presentation and disclosure, first we are going to cover exposure draft, and whatever the following from here onwards are under exposure draft only. Okay, how does an exposure draft looks like? What is it? Okay, so for presentation and disclosure, the board has launched a project. Why? Because they want to improve communications in the financial statements. Presenting means what? You're just improving what you have done. You're communicating. It's a tool for communicating your financial statements to the outsiders, to the stakeholders. Okay. So in this proposal, and this proposal is outlined where, for example, when we want to deal with non-current asset or an intangible asset, we use a specific tool, help of specific standard, which is under an IFRS or IAS standard, right? For intangible assets, we use IAS 38. For non-financial instruments, we use IFRS 9. So same way, when we have to deal with disclosures and this thing, okay? There is this proposal is not outlined in a specific standard, okay? It is outlined in an exposure draft. And this exposure draft, if you see the year, it is the short form is ED, and the year is the 2019, the latest one, okay? You have to know the exposure draft, the latest one. This is for general presentation and disclosure. General, it is not specific with this. Whatever the presentation and disclosure in your financial statement needs to follow this. Okay, it comes from exposure draft only. We don't have specific standard like IFRS or IFRS standard. Maybe in future it will become a standard, but currently, whatever current issues or whatever currently there are, it is dealt under exposure draft. For presentation and disclosure, it's like a draft form of a draft. It is not yet finalized, which is, if you see the 2019-7, that means it has been issued in 2019 in July. The month is July. Okay. So this exposure draft, what does it do? It outlines four broad proposals that will require the reporting entity. So your the next video slides that I'm going to cover will be on these 4 points, four broad principles. What are they? Number one, when you are presenting something, you have to present in subtotals in the statement of profit and loss. So what is the place where we are targeting is statement of profit and loss. Okay, there we have to uh, present some information, okay, in a subtotal. Subtotals are there, which we will be going to cover in the next slide. Then second proposal is disaggregate information in more useful ways. When you're presenting information, you cannot put everything together and put. No, you need to disaggregate some certain information so that it becomes more useful. Third, disclose information about what? Performance management performance measure that are reported in the financial statements. And the fourth one is cash flow. Some classification that were there in the statement of cash flows, now there are no more. The choice is not there. Okay, it changes the classification. There are some classification which was previously it was different, now it will be different. Okay, for certain items, not all the items in the statement of cash flows. So these are the four areas, and this four areas only will build up the rest of your lecture on exposure draft. So now let us start with the first proposal, which is, if you see the first bullet point here, defined subtotals. Okay, so according to IS1, we need to take help from IS1, okay, to know what is defined subtotal. Okay, so IS1 says, okay, IS1 does not require any specific subtotal when you're presenting between revenue and profit or loss. Okay, but if you see some statement of profit and loss, okay, some entities they present which is known as profit from operation. Okay, in fact, most of the entities nowadays they present statement of profit, profit from operation. Okay, just look at any statement of profit and loss from any company on online, right? you will get that term known as profit from operations. Okay, but remember, this is not mandatory. So not all the entities will do it 100%, but many entities do it. Okay, it's not mandatory. So those entities that present this subtotal, it's a subtotal, it's not a total, but before that there comes another total, right? Subtotal, which is known as profit from operations. So when you are taking it, profit from operations, how do you calculate it? This can be calculated in many different ways. For example, first way, some entities can include it from as a part of profit from associates and joint ventures. Okay, so whenever you're taking profit, sometimes what happens, profit from associates and joint ventures, okay, they put it under profit from operation, they include it under profit from operations. But some report it as a type of investment income. What investment income? The profit from associates and joint ventures, some of them take it as an investment income. Some they put it under profit from operations. Second, this is about defined benefit pension scheme. Okay, so some entities, whatever the interest that is there on the defined benefit pension scheme, we are referring to IS 19 here. Okay, interest on that. Where do you write it? Some they put it under profit from operations, some they report it as a finance cost because interest, right? So finance cost. So there is, you can understand, right, that classification, that some entities follow this, some entities follow that, for two items. One, profit from associates and joint venture. Second, interest on defined benefit pension scheme. So make sure that at least you know this two area. Okay, because as I told you earlier, that current issue is something very easy to deal with. Okay, because area is very less, it's not very wide like your IFRS standard and IS standard. So the wide areas I've already covered, so now nothing left, it's just a small portion. So because of these differences, because some entities are doing this, some entities are not including under profit operations, what's happening? Comparability is becoming tougher now between companies. That's the reason why this they're putting more and more guidelines under the exposure draft on how to present. So now they are proposing 3 additional subtotals, the board, for the entities, that they have to present it in this way, this manner. First, operating profit. Okay, so operating profit means from revenue, from sales, you deduct your operating expenses, such as inventory that are used, any changes in the inventory, your depreciation, amortization, impairment, professional fees, all this you deduct. It's known as operating profit. Second, operating profit and income and expenses from integral associates and joint venture. I have a demo, okay? I will be illustrating this with a statement of profit and loss, how it looks like, how this 3 subtotals will be presented. But for now, let us read the theory part. Second item is, second subtotal you need to present after the operating profit is operating profit and income and expenses. Okay, this order should be followed. After operating profit, if any income and expenses are there from integral associates and joint venture. What is this integral associate and joint ventures? We'll be covering it shortly in after a few minutes. Okay, so till then wait for it. Okay, because there are two. One is integral, one is non-integral associates and joint venture. Okay, so as per one, okay, that means from one operating profit, you add or you minus. If it's a profit, you add. If it's a loss, you minus. Okay, but it should be integral associates and joint venture. Third, profit before financing and income tax. Okay, that should be a third subtotal. That means the name of the subtotal should be profit before interest or income tax, or profit before financing and income tax. Okay, so that means from the second one, as per two means operating profit and income and expense from integral associates and joint venture, plus, okay, if there is any dividend income, you add, and also you add if there's a profit, and you minus if there's a loss from non-integral. In the second one, you are taking integral associates and joint ventures. Third one, non-integral associates and joint venture. Shortly you will understand the difference between these two. So entities must still present profit before tax. Still you have to present that profit before tax the way you have been doing it, the entities, as per 3 above. That means the third one, that's why I've written it 1 2 3. So from the third, you deduct expenses. That means third one is what? Profit before interest and tax. So if you just want to know profit before tax, just simply deduct interest from that third one. Okay. And also you have to take one more thing. when you're deducting the financing activity, the interest, you also have to deduct one more thing. What is it? Unwinding discount on provisions and defined benefit deficit. Two standards are there. One is IS 37, that is to get the unwinding discounts on provisions, and the other one is IS 19 for getting the defined benefit deficit if there is any interest on it. Right? That because earlier in the earlier slide I've told you that any interest on defined benefit deficit could be under financing costs. So from there you deduct. And the other one is unwinding discounts on provisions. Okay. So now entities must still present profit for the year. Yes, it does not stop there. Profit for the year you still have to present. What is profit for the year? Profit before tax less income tax expense. That means tax also now you deduct. One by one you deduct. You see? First is just the operating profit. Then you add integral associates and joint ventures profit or loss. Then you add, then you take profit before interest and tax. Then you deduct interest, then you deduct tax also, which is known as profit for the year. After you deduct tax also, what is left is profit for the year that you have to present. So 5 subtotals. I hope you will remember it. Okay, out of this 5, 3 additional they have done. They told operating profit, operating the first, second, and third. The last 2 bullet points you have been doing it already. Normally you have been presenting this subtotals. That is profit before tax, profit for the year. Okay. Now, so this is a demonstration on how it will look like. Let's see. This is an illustration of profit and loss account where the expenses has been categorized according to the nature. Okay. So let us go through the operating expenses. Okay. So as you can see, starting with the revenue, and then we have other incomes. Then we have changes in inventories, raw materials used, employee benefits. If you see the way the expenses are, it is employee benefit, depreciation, amortization, impairment of trade receivable, professional fees, and other expenses. So what can you notice from this? The way the expenses are categorized or classified, it is according to the nature. Because there are two ways, either by function, either by nature. For example, if it's by function, then it will be admin expenses, selling expenses, distribution expenses. But this one is according to nature. Okay, operating the operating activity section. So this is the operating section. After that, there is one element which we are going to cover in the next slide also, which is your share of profit or loss for integral associates and joint venture. What is this integral associates and joint venture? In the next slide we'll cover it. Okay, so this section, after the operating profit you deduct separate, it is separate. Okay, known as integral share of profit or loss from integral associates and joint venture. Okay, please pay attention to this word because there are two types of associates and joint ventures. One is known as integral, the other one is non-integral. Now the second, under investing activity, if you go, okay, you are taking the dividend income and the share of profit or loss for non-integral associate. You see, for non-integral associates and joint ventures, we take it under investing activity. But if it's integral, then from operating profit only we deduct. Okay. So main thing which is very important is that you need, these are the subtotals that you need. Okay, one is operating profit, then we have operating profit income from the integral associates and joint ventures, and third, profit before interest and tax. Okay, which is this. So from here, that means the financing section, this is known as financing section. All finance expenses you are deducting. Okay, so expenses from financing activity, tax only you can take, and this one, unwinding of discount of pension liabilities and provisions, you are deducting here under financing activity. So make sure that you know this. Each one falls under what. Okay. So that's it. Now we are going to cover the integral. And if you see what is the source, it is from the exposure draft. ED is exposure draft, and the year is given 2019 7. Okay, page 7. So if you want details, you can go here and go to page 7 and see, but that's not required. This shall be enough. Okay, this is just an illustration. You don't have to by heart everything line by line. That after this will come, but at least you should know the subtotal, what it should be, the three subtotals. Okay. So now we are going to cover the integral, associates, and joint venture. Now, so now we are going to cover integral, associates, and joint venture. What is it? See, some entities they present income from associate as a part of a operating profit. Okay, but others they do not. Why? One reason for this is what? That some associates undertake the same ordinary activities. Sometimes associates take the same ordinary activities as their investor or his subsidiaries. Sometimes they don't. So when they take similar activity as the investor or the subsidiary, that means for example, let's say you as a parent, okay, your associate is taking a similar activity. You are in a construction industry and your associate is also in the construction industry. Then it is known as an integral associate. Integral means part of it. But if it is not the similar activity, then it is known as non-integral. Hence, non-integral associates and joint venture. So that's how you differentiate. You check the activity, whether it is similar or not. Okay. If the associates operate in completely different industry that is different from the rest of the group, then it is non-integral, otherwise integral. So this is the factor. So in the above pro forma you have seen, right, that how the board is proposing to differentiate. They have shown two separate lines. One subtotal is for integral associates and joint venture, the other one is they are deducting the non-integral associates and joint venture losses or adding the profit. Okay. So in the exposure draft, okay, how do the integral associates and joint ventures are defined? Integral associates means those that do not generate return individually. Individually, they don't generate any return. That was similar activity to the group. That is the meaning of integral, simple in simple terms. And they are not independent. They are very dependent. Okay, if they're independent, that means they are non-integral. Now, second proposal by the board is disaggregate information. We are over with define subtotal. Okay, don't worry if you are panicking that you lost the track where you are at, because so much of information, I know you have to observe so much of information under current issue, but the good thing is I have summarized everything at the end. We'll be summarizing everything. Okay, a short summary is there, very short, so that everything is backed up. Now, disaggregate information, this is there in three areas where you need to disaggregate. One, operating expenses. So under operating expenses, okay, operating expenses you can disaggregate in two ways. One, by its function, such as cost of sales, admin expenses, distribution expenses. Other, by the nature. For example, raw materials used, the depreciation, because depreciation, the nature is different, employee expenses, nature is different, okay? As in the pro forma above. So the illustration that I've shown you, the pro forma, that was classifying the expenses by nature. Did you see? Depreciation, amortization, they were doing it like that, impairment, not like admin expenses, cost of sales. It was not like that. Okay. Under IFRS standards, entities can present in any way. They can either classify by nature or by function. Okay. But because of that this way or that way, same thing, same issue again. Comparison becomes very difficult. Okay. And some investors are also concerned that maybe some entities might be choosing the format. For example, they might classify by nature, whereas classify by function would prove more better. So in this way, if they are choosing in inappropriate format, what happens? Important information is lost. Okay. For example, if you are classifying by function, let's say your what do I say? Okay, let's say your depreciation. So your depreciation, all those things comes under your admin expenses, let's say, or employee expenses. So now if you want to know how much is your employee expenses, the wages or salaries that you are paying to the employee, how will you know? Because it is everything under admin expenses. It becomes very difficult now, right? So sometimes this is better, sometimes that is, it depends, right? So because of that, what did the board propose? See, always some issues there. That's why board is proposing. Okay, that's why this current issues keeps updating every year. Some issue will be there which has been solved or it is not yet solved. So some new standard they will be making. Okay, so because of this issue, what happens? The board is now proposing that when you are presenting expenses, okay, they are emphasizing that when you're presenting expenses, whether by function or nature, it is not a free choice anymore. It's not that whatever you wish you do, that I want to show by function, so I will show by function. I want to show by nature, I will show by nature. It's not like that anymore. Okay, instead you have to present in such a way that will give most useful information for your user. You have to select in that way. If you feel for your company presenting expenses by function is better, then do so, otherwise by nature. Okay, so the main criteria here is out of this two method, which one is giving you the most useful information for the user. Based on that, you have to decide now, not on your free choice. Even though, yeah, you can say in literal terms, you might say, yes, choices are there. Okay, but the board have proposed this so that you do not manipulate that choice that you have been given out of nature or function. So if you are presenting expenses by function, like admin expenses, sale expenses, distribution expenses, you have to disclose a comprehensive list of expenses by nature also. Because some under the function, all the nature, if any expenses by nature, for example, under admin expenses, there may be 5, 6 costs, but we don't know what are how that admin expenses is being made up of. What are the expenses that makes up that admin expenses? What are the expenses inside that admin expenses? You don't know, right? So even if you present information, your expenses by function on the face of the income provident statement of profit and loss, but when you're making the notes to the financial statements, there you have to write a list of all the expenses by nature so that they can verify that okay, admin expenses, this. There are 6 costs that makes up the admin expenses. How do we get that 6 cost? From the notes. So in short, you have to give both the types of expenses. Both you have to disclose. One you are giving on the face of the statement of profit and loss. The other one you are giving through notes. So that means, in short, you are doing both the ways. It's a lot of work, but there's no other way, right? Users needs to be protected. They need to know this. So you are giving comprehensive list of expenses by nature also. So on one place by function, the other place by nature. Okay. Now, second item where we are going to disaggregate is unusual income and expenses. First one was operating expenses. Now unusual income and expenses, something which is not very usual, not very recurring, not happens every day. You need to disaggregate. And disaggregate in this kind of information is very easy because it's one off. Items are not so much. Okay. It's non-recurring. It does not happen frequently. Maybe once or twice it happened. It is something which is not normal, right? Outside that norm. So that is known as unusual income and expenses. And this is very important for the investors because sometimes this could be very significant, very material. So this can help them to predict the future cash flows and profit, right? How can entities provide this information, this unusual income and expenses in different ways? Number one, many entities, what do? How do they record unusual expenses? They separate it from the other items, other expenses. Okay. In the statement of profit and loss only they write, but they show it separately. They write it exceptional items or non-recurring. Like this, they you might have heard, right? Or some entities they do not show this also at all as a separate line in the statement of profit and loss. Then what do? They disclose it. Okay. They prefer disclosing this under disclosure notes rather than putting on the face of the statement of profit and loss as a separate line. Or few entities they report or disclose information about unusual income. This is about unusual income, okay, not expense. Very few entities they either report or disclose about this unusual income. So because of this, what happens? Some entities write it as a disclosure, some they put it under statement of profit and loss. Because of this, again, comparability. So all these things, the issues happening is what? Because comparability is being it is being hindered, right? So because of that, what happens? And it becomes very tough for the user, right, to compare. And also there is a lack of clarity also. It's not very clear what is the meaning of unusual item. Which item should you take as unusual, which one you should not take? Because no standard says that okay, this is unusual item, this will not be unusual item. So that also makes it very difficult. Clarity is not there. This also limits the usefulness. Okay, so again it becomes harder for the investor. Now, so to address this, okay, what happened? Comparison issue is there, right? Some you disclose, some you don't disclose. So what is the board proposing? The board is saying that define, they are now giving a definition to it. The unusual income and expenses. What is the definition? Limited predictive value. According to exposure draft, okay, limited predictive value. That means very limited. You cannot predict anything based on that value. Very limitedly you can predict. That is the meaning of unusual income and expenses. Okay, another meaning is when an income or expenses of that similar type will not arise in the future. Will not arise for several future. Okay, let's say in 5-6 years you expect that this type of expense or period income will not arise, then you take it as an unusual income and expenses currently. Okay, at least for several future. You don't know, you cannot say it will never at all, it will never arise. No, sometimes it might come again, but let's say for 10 years or 5 years this will not arise, so it is known as unusual income and expenses. Now the board is also saying that this unusual items, they should not be shown as a separate in the statement of profit and loss. Then what? Then how are you going to present it? Rather, they should be included within the most appropriate category. Whatever you feel is most appropriate for this type of unusual income and expenses, you include it there, rather than putting it as separately like other. Sometimes you must have seen that title, right? Others. Because you cannot classify what type of expense it is, you put it under others. No. They say if, for example, you believe that that unusual income or expenses falls, it's most likely to be an employed type of expenses or admin expenses, you put it under that. Employee expenses or admin expenses. Okay, so now, so when you are reporting this, okay, the board is proposing disclosure of what do you need to disclose for unusual income or expenses? Once you have identified, yes, this is unusual. First of all, you need to identify that this is unusual. Then only comes about reporting or disclosing or whatever. Once it is identified, then you disclose the certain things. What is the amount of that unusual and unusual income or expenses? Very important. Second, description. You need to describe it also how it arises. Just giving amount like normal income and expenses not enough. Nature needs to be known. How it arisen and why it meets the definition of unusual. Why are you saying is unusual? You can say because you predict that in few years it will not arise. This has never happened before. Something like that. Some definition has to be there. And third, line item. So when you're putting it in the line item in the statement of profit and loss, where it is included. For example, that unusual income and expenses, you are classifying it under admin expenses. You need to write why. You have to write which places you are including that unusual income and expenses. Whether is it under employee expenses, admin expenses, you have to show, okay, where it is included. Very important, these three things. Okay, third are other items that are not operating expenses, that are not unusual income and expenses. The others are, how do you disaggregate? So any dissimilar immaterial items, you can group them together. Dissimilar means they are not very similar to each other, but they're so immaterial, they're very small. Even if you group them together, it will not affect so much. So those you can group them together. Okay, if there are several immaterial expenses, so you, rather than writing other expenses, okay, avoid it, because this is not very clear. It's very vague, right? Other expenses. You don't know whether other expenses is material or immaterial or what it is. Okay. So avoid that label. Okay. Rather, you have to disclose the nature of the expense. Okay. So now the fourth required, like this comes under other issues. Okay. Dissimilar, if there are any dissimilar immaterial items. Dissimilar, if it's material, you cannot group them together. If it's immaterial, then only group. Required line items. These are required line items. These are very, it's required. You need to disaggregate. You need to show it separately only as a line item. One single line is for this only. What is it? One is goodwill. Goodwill, you do not put it under intangible assets, even though goodwill is an intangible asset. You show it separately on the statement of financial position. Okay, you have to show it separately. So now let us go to test your understanding 3 to better understand how to what? Disaggregate. Test your understanding 3. So you have been given the statement of profit and loss for a construction industry. Let's see. So you have been given the revenue, cost of sales, gross profit distribution, admin, finance. Just check the way it has been categorized, the expenses, whether it is according to the nature or the function. Okay. And the share of profit of associate is 9, and then we have profit for the year and all. Okay. So now the investment in the associate was made several years ago. The associate does not operate in the construction industry. It's very important. Several years and does not operate in the construction industry. They have long-term provisions, and all expenses, where is it recognized? Under admin cost for the provisions. And if you see the closest competitor, they present expenses by nature. Okay. So you are required to discuss the potential impact on the Spirits Group statement of profit and loss if they implement the proposals that were outlined in ED 2019-7. ED is exposure draft, and 2019 July for general presentation and disclosure. Okay. So according to this, how expenses has to be disclosed or presented. There are two ways. One is function, one is expense. Let's see how the answer is. Very descriptive in nature. Looks very hard, right? Especially, see, when it comes for specific standards like IFRS 9, we know these are the rules, so we go by the rules. What about exposure draft? What about management commentary? What about practice tape? What about this type of questions? How do you deal with this? Here also we have very specific things. For example, this now, when they have talked about exposure draft, it is not talking about the wide exposure draft. Not all the aspects of exposure draft you have to answer. You only have to answer relating to the expenses, how they are presented. It should be presented according to the nature of the function. That is your question. Okay, that's why you have been given the expenses. So you start your answer with the expenses part. Okay, one by one. So the first paragraph, they are talking about the expenses. If you see the expenses in this statement, it is presented according to functions. How do you know its functions? Because it is according to cost of sales, admin expenses, finance expenses, operating expenses, like that. So it's based on function, not nature. If it was nature, it would have been like depreciation, employee expenses, and all. Okay. First, understand the difference between these two. You need to understand. Then what does the both say? You need to understand what the exposure draft says. The exposure draft says, or the both says, presentation of expenses, whether by functions or expenses, should not be a free choice. Yes, there is a choice, that this or that, but it's not a free choice. There are limitations when you are choosing whether nature or function. How? When you are presenting any expenses, whether under nature or function, you have to first see if you present under function or if you present under nature, which one of the two is giving you the most useful information for the user, for the financial statement user. You have to see from this angle and then decide. This is your deciding factor. Whether if you present by nature, it is giving you more useful information, or by function. If it's by nature, then choose nature. If it's by function, then choose function. Okay. So, but for this also, okay, you need to see other factors. deciding factors such as wider industry practice. In the wider industry practice, how do they present? If you see in your industry whether they normally present it as a function or as a nature, you have to see that also. And also the manner in which information is used internally by the management. How the managers are using this information internally, you have to see that way. Internally, how they're using it. So that could be a way for you to deciding factor. So in this case, you have been given one fact that competitors, they choose by nature. They choose to present expenses by nature. So this suggests that maybe nature might be better way for the user of this one also, because it's a competitor. Competitor means similar, right? To compete with someone, you have to be something of similar nature to him. Two different things, two people cannot compete with each other. Some comparison has to be there. So if competitor is using nature, better you also use nature, right? Because in this case, your user also will get more useful information if it is presented by nature, not by function. But in your case, you are choosing by function. So now we are moving towards the associate part. Okay, so the second paragraph only talks about associate. Okay, so they have line item. Line item wants one single line. If you see in your requirement, just see one line only. One separate line is there for share of profit of associate. 9. They didn't write it under any. They didn't break it down, or they didn't put it under anything else. Okay, but what does the board say? Under the board's proposal means always they're referring it to the exposure draft. Under that, what does the board say? So they proposes that they must classify the associate. So if you break down this information like this, according to exposure, it's very easy for you to write answers like this. Okay, even for exposure draft, you must classify associate and joint venture both. You cannot keep it as associate. How? As integral or non-integral. What is the meaning of integral? Integral means it does not generate a return individually. Integral means something, it is very connected to it. Integral, part of it. If it's in the construction, it has to be in the construction only. Then only you can say it is not individual. If something they are getting a return individually from someone else, then you cannot say it's an integral. It's a non-integral. Okay, and largely independent. If it's largely independent, it's not integral. You cannot say it's integral inside it. So in this case, it is non-integral. Why? Associate is non-integral. Why? Because of this. They say this does not operate in the construction industry, associate. So that means they give return from other industries also, not just the construction. So it's non-integral. And if you see this one, they do not report an operating profit subtotal. Anywhere did they mention that operating profit? No, they didn't. But what does the board say? You have to make this subtotal mandatory. That means operating profit, you mandatorily you have to write it. But they didn't do it. Underneath, after the operating profit, please follow the sequence, okay, when you're mentioning it like this. After the operating profit, again the board proposes that they must report the share of profit or losses from integral associates and joint venture. Okay, and this should be followed by another subtotal. After this, there is another subtotal called operating profit and income and expenses from integral associates and joint venture. Everything is to do with integral associate joint venture. But see the order. But in this case, it would seem that there are no investments in integral associate. So these two subtotals will be the same if they does not have any investment in integral associates. Okay. So remember they have talked about something to do with provision. That also you have to explain in your answer. The last paragraph talks about that only. So any expenses that arises from unwinding of the long-term provision. Unwinding of long-term provision, where do you recognize it? Under finance cost. But here they have recorded under administrative cost. So this has to be prohibited. If you go by the nature, you have to prohibit this because you have to write it under finance rather than admin cost. So that's it. That's it for test understanding 3. Now we are moving towards management performance measure. So two areas we have covered. One is subtotals, the other one is disaggregation of information. The third and the fourth. Third is management performance measure, fourth is cash flow. So management performance measure, how do you disclose or present this one? Okay, many companies they choose to disclose such as adjusted profit, adjusted operating profit, and EBITDA. Okay, they can provide useful information. Okay, why? Because this measures they can provide some useful information for the user. Okay, to assess the performance of a company. But still, some investors are not happy with this as well. Why? Because they are worried about the quality of this disclosure. So how the board is proposing to address this issue? Because it's a concern for the investors, right? So now the board has proposed that they are going to define what is this management performance measures are. Okay, so this management performance measure as subtotals of income or expenses. That means it should be a subtotal of income and expenses that are used in the public communications outside of financial statements. Okay, that is the definition of management performance measure. It should be something which is not there in the financial statements. Outside of the financial statement, if you are making any subtotal of income and expenses, okay, which complements the total or subtotals that are used by IFRS standard, it is not used as a substitute, okay, for the information that is given in the financial statements. No, it just complements, enhances the information that is already there in the financial statements. Okay, so that is the job of the management performance measure. It enhances, it complements. Okay, so if an entity reports this, then the board says that they must also disclose certain things. What are those? Reconciliation has to be there between the management performance measure that you choose to disclose and also any comparable subtotal for that management performance measure which is under IFRS standard. Second, effect of any tax and NCI for each reconciling item above. Okay. Third, description of importance of each additional performance measure. You have to describe why it's important. When you're choosing a some specific management performance measure that you choose to disclose, why is it important? You need to describe. And how it is calculated, you need to describe. Remember, this management performance measure, they don't have a specific IFRS standard. So it's not very objective. It's not similar for every entity. That's the reason why you have to show how you have calculated as well as explain the importance. And if it changes, okay, for example, you have choose to change how the management is calculating management performance measure, you need to explain that as well. Okay, so the board believes that few, okay, out of all the management performance measure, maybe at least very handful, very few should be presented on the statement of profit and loss, not disclose. Why the board believes it like that, that few has to be given on the statement of profit and loss only? Because this gives the non-IFRS measures undue providence. Okay, if you don't do that, it will give the non-IFRS, that means all the measurement performance measure will be taken as very important, whereas in reality only very few are very important. That's the reason they told no, let's put it on the statement of profit and loss. So show that the importance is increased for those items, for those management performance measure which are presented on the face of the statement of profit and loss. Okay, that means you have to give it in a separate column when you're presenting it, the performance measure, the management performance measure. One will be on the statement of profit and loss, the other one will just be on the disclose, you will be just disclosing it. Now how do you do that? Okay, let us see through test your understanding 4. Very short test your understanding. Test your understanding for Aspire. Okay, so the directors of Aspire repose a management performance measure to its stakeholders called underlying profit. Okay, the performance measure is calculated by taking profit before interest and tax for the period and then eliminating foreign exchange gain and loss, trade receivable impairments, and non-recurring items. Underlying profit is displayed on the face of profit and loss. And a brief Discursive explanation of the method of calculation is provided in the disclosure note. Now what are you required to do? You are required to discuss the impact that the both proposal as outlined in the exposure draft under general presentation disclosure will have on their disclosure of underlying profit. Okay, if you see this answer is very short. So what does they do? They do provide brief and discursive explanation of the calculation method, right? But apart from this, they also need to explain the importance also of this management performance measure. Okay, and more than this, they need to reconcile this profit before interest and tax and underlying profit, right? So for each reconciling item, the tax effect must be calculated and disclosed. When you are reconciling it, profit before interest and tax, the tax effect of this must be calculated and also it must be disclosed. Okay, but they will not be permitted. Okay, the company will not be permitted to present the management performance on the face of the statement of profit and loss. Maybe under disclosure note as a note you can write, but not on the face of the statement of profit and loss. You're not required to do that. Prohibited. It's not permitted, right? So that's it for test understanding 4, and we are just left with one more, test understanding 5, and that's the end. Now let us go towards the last part of this video, which is the statement of cash flow, before I actually wrap up the session. So at the moment there are some variation, okay, how entities prepare and how they present the statement of cash flow because of the same. So if you see all the issues that is happening, whether it is materiality issue, the presenting and disclosure through statement of cash flow, or the way you disaggregate, the way you put the subtotals, the main reason is comparability. Everywhere it reduces comparability. So this makes it very easy for you to learn. The main reason is reduces comparability. That's why board is proposing better ideas, the way how you need to present, how you need to disclose, how you need to measure, how you need to recognize. So now they are proposing the following changes. Okay, operating profit. Okay, it should start with the operating profit. The starting point when you're making a statement of cash flow using an indirect method should be from operating profit, not profit before tax. Okay, when you are told to prepare the cash flow from operation, starting point is operating profit, not profit before tax. Second, you need to differentiate between integral and non-integral associates and joint venture. Okay, the cash flow that you are receiving, very important. From the cash flows perspective, for example, the profit and loss. Okay, you will be adjusting that profit and loss somewhere in the operating cash flow from operation with the operating profit. So there you need to differentiate between integral and non-integral. Okay, and classification choices are removed. Certain classification choices were there which you had, now it is removed. For example, you might classify an item under investing also, under financing also, under operating also, under investing also. Now it is removed so that comparability can be increased, right? So this table, okay, you understand this table, you understood everything about statement of cash flow. So these are the 4 areas that there were choices, not all the items in the statement of cash flow, only these 4 areas. Interest paid, current treatment is it could be it could come under operating or financing. Remember, under operating activity we used to deduct, and also under financing also we might deduct, because interest we say that interest is a finance expense. But now the proposed approach is finance only. Out of operating or financing, take it as financing. Okay. Second, interest received. Interest received also operating or investing. Okay, see the word. When it comes to interest received, it's not financing anymore, operating or investing. Operating will remain, okay. Interest paid or received can be operating, but if it's paid, financing, if it's received, investing. But the proposed approach is take it as investing. If it's dividend received, same. So whether it is interest received or dividend received, current treatment is operating or investing. Proposed approach is also same, investing for both. So this way it becomes very easy. You don't have to remember what is received. If it's received, investing. If it's paid, if it's paid, it's financing. Okay, dividend paid like interest paid, operating or financing. End result financing. So whether dividend or interest is paid or not, financing. sorry, if it's paid financing, whether it's interest or dividend does not matter. Same for received, it will be investing. So there is nothing to touch on operating section. Okay, this four areas will not come under operating section. Becomes easy. Okay, what is that strike over there next to proposed approach? Why is it so? Because some companies such as banks, they will have other classification choices. Okay, and this depends on how the related income or expenses has been classified in their statement of profit and loss. Based on that, they will see whether interest paid will be operating or financing. So for bank, it will be different classification, but generally the proposed approach, you have to go by the proposed approach. Okay, now don't ask me questions what in the exam if they give us bank, they will not give you banks. Exceptional case, they don't give, they go by the majority session. That is the beauty, that is the good thing about ACC. Okay, that is just my understanding that they have given that. Now, providing useful information. When you're providing useful information, again, you need to, this also comes under presentation disclosure rule, exposure draft. Okay, not all information you have to give, useful information you have to give. Okay, this also, when you are told to provide useful information, again, board is now proposing some changes in this aspect also, in how you are presenting and disclosing it, so that you can increase the usefulness of that information. For example, okay, some examples are there. Unusual income and expenses. Okay, if there is any unusual income and expenses, we know it is very unlikely that it will occur again. Okay, so that's the reason you need to properly identify it, whether it is unusual income or expense. Okay, then you need to disclose it. After you identify, disclose it. Okay, so once you have identified and you have disclosed it, it will improve the relevance of that financial information. Relevance will be improved for the user. Okay, and now they can better predict the future profits and cash flow. Then many entities, they calculate operating profit. Okay, and they present certain cash flows in different ways. Okay, because of this, comparability becomes harder. So when you are removing these choices, there is no choice. We just saw in the statement of cash flow, choices are removed. Comparability is improved. Okay, this is like a summary only. Advantages of the proposal that the board is telling, right? Putting forward. So choices are removed, comparability is improved. You are better identifying unusual income and expenses. Again, the predictability of cash flow is improved. Third, these are some examples how useful information can be provided. Now we are touching on the management performance measure. Okay, usually what happens when you are giving any management performance measure, okay, it has been argued that you normally want to present those information which gives a better picture. You want to show overly optimistic picture of yourself, of your company, right? So because of this, if there are some enhanced disclosure in this area, a management performance measure, then transparency is improved, credibility is improved, and it contributes more faithful representation. Why? Because one of the qualitative characteristics of useful information is what? What are the two fundamental characteristics of useful information? Relevance and faithful representation. Yes, so that's what it's achieving it. Faithful representation and relevance. This two are improved. So that means information becomes useful. So now let us see this through test your understanding 5. The last test your understanding. So now finally we have come to the end of this video. We have covered everything. Now this is the last question, test your understanding 5. So let's see. What are you required to do? First of all, there are two requirements. Number one is you have to explain how this should be accounted in according to the IFRS. Second, you have to discuss the why the accounting treatment will be different from the conceptual framework's definition of elements. Definition of elements means what? For example, how they have defined assets, liabilities, income, expenses, equity. Okay, the way conceptual framework has defined. But this accounting treatment is differing from that. Why, you have to explain. So before we go to the second, let us first deal with the first one. Okay. Mineral owns a machine that is central to its production process. Okay, so the main thing is here machine. At the reporting date, the machine's carrying amount exists tax base. So as you can know, they are talking about tax base means they are referring to IS 12. Okay, these are the keywords. Okay, whenever you see some words, you should immediately know which standard they are touching on. They will not say, okay, this is under IS 12 or on, no, they will not specify like that. So this is from IS 12. Carrying amount exists tax base means what? It's a deferred tax liability, not an asset. Deferred tax liability because carrying amount is greater than tax base TB. Okay, so why is this difference? This difference is due to the revaluation of the asset to the fair value in the financial statements. Whenever revaluation takes place, what happens? Your carrying value will definitely increase more than your tax base. So definitely your carrying amount will be more than the tax base, which is giving deferred tax liability. Okay, higher deferred tax liability. Okay, so this is because of revaluation. So because of this, due to this its importance, it is extremely unlikely that machine will be sold. Okay, so in this case, unlikely that the machine will be sold. At the year end, they received 10 million. In return, they must issue ordinary shares in 12 months' time. They must issue ordinary shares. Number of shares to be issued will be determined based on the quoted price of mineral shares at the issue date. So this shares will be based on the quoted price at that issue date. Now you have to explain. Okay, how this will. So this is the topic is deferred tax. It comes under IS 12. Okay. So how do you start this question? How do you deal with this? First of all, you need to write the place where this deferred tax will be recognized. Okay, and how are you going to calculate this deferred tax? You have to explain. Remember, whenever there are no numbers, when you cannot take the help of any number, you should be able to explain what you would be calculating. That's the first thing you should do. So the first paragraph talks about how you're calculating it. Let's see. Here they are giving you what is exactly there. That carrying amount exists tax base. So according to IS 12, this deferred tax liability will be recognized. You have to write all this. Because we don't know it's a deferred tax asset or liability of whether it should be recognized also or not in the first place. So you have to write it that this will be recognized. Why it has to be deferred tax liability has to be recognized? Because carrying amount is more than tax base. This also you have to explain. Because carrying amount is more than tax base, therefore deferred tax liability has to be recognized. So this is also another way of writing. You're just rearranging the words. Okay. How do you measure this? We told, okay, carrying amount is more than tax base, therefore deferred tax liability. But how do you measure, calculate? By multiplying the temporary difference. Remember the difference between carrying amount, the carrying amount and the carrying amount of the asset and what? Tax base is known as temporary difference. So this temporary difference only you multiply with the tax rate and find the deferred tax. Okay, where does this tax will go? It will go under other comprehensive income. This first paragraph is very important. It sets the tone for the rest of your answer. If you mess up here, your whole answer gets messed up. But remember, if you write, some of you might mistakenly write deferred tax asset also. Okay, so for deferred tax asset, 1 mark will be cut. I mean, you will not get that 1 mark. It's a wrong answer. But if you follow on from there and write that under conceptual framework, the definition of asset is like this, but this is not your mark. You will not be penalized twice. Okay, you will only be penalized once for incorrectly saying it's a deferred tax asset. But from there onwards, if you follow on, okay, it's not that because you're carrying it forward and writing your answer based on that deferred tax asset, your marks will be cut or you will not get marks or you will lose so many marks. No, you are only penalized once. So that's an advantage that you have. Okay. But usually under IS 12, this is based on my observation and experience that usually candidates don't make this mistake on in recognizing deferred tax asset or a liability because it's very easy. Okay. Second paragraph. What does second paragraph have to do with it? You have to link this with the conceptual framework. How do you link? Before linking, you should know how to come to that point. You straightly cannot say, okay, under conceptual framework, this is the asset, deferred tax asset is liability. That's why, no. You should know that linking point. How? From conceptual framework. First of all, deferred tax asset is what? It's an accrual concept. Talk about this. Accrual concept. Okay, where it's an accrual concept. If for all of you who does not know what is accrual concept at this stage, okay, it's okay. Sometimes you forget what is accrual concept. The exact words or definition you again want to revisit, you can still always go back and revisit, or you can Google is there, right? So Google it and check accrual based cash concept, right? So that means this recognizes the tax effect in the period when the transaction actually occurs. That is the meaning of accrual concept. Whenever the transaction occurs, it does not mean that you have paid the tax already in cash. No. Tax effect is recognized in the period when the transaction occurred. That is the meaning of accrual concept. Okay, this is how you apply the deferred tax. But in this case, mineral has no plans to sell this asset. Remember, you have to pay this tax when you're selling this asset. Okay, while you're selling this asset, that time you have to pay this tax. Not now. Now it's just deferred till that time when you, in the future, when you are going to sell the asset. But in this case, you have no plan to sell this asset. So because there is no plan to sell this asset, there is no present obligation also to pay the tax that arises on its disposal. Can you see? This line you have to write before you come to the conceptual framework. This is the linking point. Okay, maybe I can highlight it for you. So plans to sell this asset, no present obligation to pay the tax. And remember, this technique not only for this, it has to be used for any answer in your ACCA. I'm not saying SBR because it's not specific for one subject. Because what is applicable for one subject is applicable for all the other subjects, right? Maybe the concept might be different, the answers might be different, but this technique is used forever, right? So you cannot just blah 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 blah. Okay, this is the definition of liability under conceptual framework because there's a deferred tax liability. No, you don't start your answer like that. Because we are on the deferred tax, so you keep on talking about deferred tax until you reach a point where you can talk about conceptual framework. So this is that plan. Why? Because no present obligation to pay tax. And for a liability to exist, so from here onwards, you are getting this point. Let me show you. I don't know whether you can follow up. Okay. So from this line to this line, you get your answer already. You know what to write. Why? Because no present obligation. So this present obligation, what is it? If you have a present obligation, it's a liability. According to conceptual framework, you already got the answer. So from there onwards, build up your answer. So now you can say, according to the conceptual framework, how a liability is defined. Give the definition of a liability. Okay, if you forgot the definition of a liability according to the conceptual framework terms, don't worry. At least some words you can pick up. For example, this word, keyword, present obligation. This you can write in your answer. Already you have got from here. Present obligation. So if you see the first answer also is present obligation. So a present obligation of the entity to transfer an economic resource as a result of the past event. That means you have an obligation now to pay something. Why? Because of some past event that was there. So transfer because of past event. So present obligation, past event. Present obligation, past event. Make sure these two words are there. Same for asset also. But in asset, it's not present obligation. It's a right. Right from the past event. So past event is whether it's assets or liabilities, it comes under both. Okay, this para and all is not needed in your answer. Don't memorize the numbers and all, it's not at all needed. Okay, so according to this, if you go, okay, you told that you have to recognize what? Deferred tax liability, right? This must be recognized according to IS 12, but this is differing with your conceptual framework because according to that there is no obligation to pay this tax. So you see, you get your answer already. So deferred tax liability, it does not meet the definition of a liability according to the conceptual framework. It differs. Okay, but the board says no. They are rejecting this position. Why? Because they argue that increases in the carrying amount of an asset, because they think Even though it's because of revaluation, they think because your carrying amount of the asset increases, this will result in future economic benefit. Okay. So they think because of that, this economic benefit will be subject to tax. So for example, if you see in this case, what is it? The fair value gain, right? This fair value gain could be anything, maybe because due to higher selling prices for his output. Okay, so which will increase your taxable profit. So they argue that no, they say both says what? No, the tax is payable on this revaluation. Irrespective of how the asset is used, it does not matter whether you are selling the asset, keeping the asset, you have to pay the tax. This is how they are justifying it. So you have to talk about the both justification also, because the question did not say whether it meets or not conceptual framework. The requirement is why. Why? This why is very important. Why if it's different? Because of the board's perspective. That they think tax will be payable and all. Okay. So now we are moving to the financial instruments. We have to see whether it's a financial instrument or not, because there was they were talking about something, number of shares to be issued and all towards the end. So next is financial instruments. So under this, according to IS 32, okay, presentation. See, don't get confused between, there are three standards which deals with financial instruments. One is IS 32, one is IFRS 7, and the other one is the main one, which is the biggest, is IFRS 9. IS 32 talks about presentation. Presentation means whether it should be financial liability or an equity. Whenever this question comes, financial equity versus liability, it is IS 32. You have to refer to IS 32. Whenever it is about disclose financial instruments, it is IFRS 7. Other than this two, anything else, financial instruments, the main standard, which is IFRS 9. Okay, this is the easiest way you can remember the three standards. So this is IS 32. Okay, they say, so according to IS 32, give the definition of the financial liability. You have to first start with it. So financial liability is the contract to deliver cash. Correct? That means an obligation to deliver cash, or it could be any other financial asset also that you have to deliver, not only cash, because cash is also a part of a financial asset also, right? Or a variable number of the entity's own shares. Okay, if you have to give up your own share and that share could be variable, then it's a financial liability. So make sure that you talk about cash, financial asset, and entity's own share, and it has to be variable number. Remember, if it's a fixed number, then it cannot be a financial liability. Here they're talking about whether if you have to transfer variable number of entities own share, then it's a financial liability. So in this case, what does the contract say? They say mineral deliver as many of its own equity instruments as, and they're equal in value to a certain amount. So they have to give up their own equity instruments that are equal to some value. Okay, they're equal in value to some certain amount. So according to IS 32, they should be classified as a financial liability, because it means the definition that certain amount of shares you have to give. Okay, just again we'll go there. You see, they told number of shares to be issued based on the quoted price on that issue date. So you know that this amount, whatever the quoted price, at that price you take, that is, you are sure of that. It's a certain amount. So it's a financial liability. Now you have to link this with the conceptual framework. How? Sorry. So first talk about specific standard. Earlier you talked about IS 12 because it was deferred tax. Now you're talking about IS 32 because financial instruments. Then you talk about conceptual framework. Okay. So according to conceptual framework, give the definition of an equity or a liability and then say which one is better. So what is the meaning of equity instrument? For it to be equity, it should be a resource of an entity. Okay. But in this case, equity instrument is not a resource of an entity. And so this contract does not represent obligation to transfer an economic resource. Okay. Equity instrument is not a resource of an entity, number one. And this contract does not have an obligation also to transfer that equity instrument. So in this case, financial liability does not meet the definition of a liability according to the conceptual framework. Whether it's financial liability, whatever liability, when you're comparing it with conceptual framework means it should meet the definition of a liability. It does not meet. Because for it to be a liability, you should have some obligation to transfer equity instrument. Okay? Which is not. You don't have that obligation. Okay? So that's it. And now finally that's the end. Now finally let us summarize what we have covered in this video. So that's it. Now let's summarize everything that we have discussed today under current issue. Okay. So we started with the current issue. We have talked that under current issues we have some criticisms of existing standards, which I have given you a table. That some specific standards has been criticized and it has been explained in the certain chapter. I've given it the chapter number also according to the Kaplan textbook. So make sure that you go through those. And also my videos are there, so you can check out those videos also. Then we went through the SBR syllabus. Okay, in the SBR syllabus we are going to cover the rest, everything else. So under current issue, there were three current issue. The first one was cryptocurrency. We went through ICO and then we went through the natural disaster. Under cryptocurrency, we told it is not cash, it is not cash equivalent, it is not a financial instrument also, it is an intangible asset, but there were some limitations and all. Then we went through ICO also, okay, very similar to cryptocurrency. And then we went to the natural disaster. Natural disaster has implications on those four places: the impairment, the insurance, the additional liabilities, and going concern. If you go by the standard, it will have an impact on IS 36, IS 38, IS 37, IS 1, right? Then, so that is all about the current issue. Then we have second topic that we touched is materiality, the practice statement for making materiality judgments. Under this, we have covered these four areas. How do you recognize and measure? How do you use this concept to recognize and measure? General materiality for everything. Present, how do you present and disclose material items? User, who is the user and the process of going through it. Then we went through the management commentary. Under management commentary, we went through the purpose of management commentary. How do you present management commentary? We know it is not mandatory, right? The elements of management commentary and how do you provide useful information using management commentary. And finally, presentation and disclosure. Under this, we went through the exposure draft. All these things are under exposure draft. What is it? Define subtotals, the three subtotals that you are supposed to define. I have illustrated you also from the statement of profit and loss. Then the management performance measure. How do you present it? All this on the exposure draft. Subtotals, management performance measure. Then statement of cash flow, right? Some choices were there, now it is not there anymore. And finally, the disaggregate information. Disaggregate information itself has impact on three places. One is operating expenses by nature or by function. How do you disaggregate? Then unusual income and expenses. How do you disaggregate? And the other issues. So that's it. This is the summary of the current issue. So finally, the last topic for SBR is also over. Okay. And the next I will be covering is questions and answers. This is from your Kaplan textbook. Behind your textbook, towards the end, you must be seeing, which is your chapter 24 of your textbook. There are some questions and answers which I'll be covering later. So that's it. I have covered all my lecture. The whole syllabus for SBR is covered. Okay, if you have any doubt, you can ask me through email, Insta, Facebook, WhatsApp, right? I'm there on all the social media. You can ask me anywhere. And so I'll be seeing you in the question and answer. And now what's remaining for the December exam is the revision kit. Revision kit questions needs to be done. I have done some most of it is not done. I think 20% is done, 80% needs to be done. So that I'll be covering now, because from textbook SBR is done. Okay, except the question and answer part that I'll be covering it. So that's it. So finally, successfully, SBR syllabus is over. And thanks for watching patiently. I know it's very long, but what to do? This everything is very important. That if I put it separate videos, people will become very confused. What is important? What is not? What which video to watch? What not to watch? So it's better everything I put it under single video, so that this one video make sure that you don't forget to forward to your friends who needs help, because current issue is an area that everyone needs help. Other areas more or less you must have studied from your financial reporting, so you will have some understanding, but current issue is something which is not there. Okay, so make sure that you go through it. Till then, thanks for watching and see you in my question and answer session and also my revision kit questions. Thank you.